morning. It is Tuesday, December 27th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Jared Blakely, Brian Sozzi, and Brad Smith are off today. So let's get right to the top three things you need to know as the clock hits 9 a.m. Stock futures looking a little mixed heading into the final trading days of 2022. Will a Santa Claus rally appear and lift a market that's been weighed down by recession fears? We're breaking down the worst year for stocks since the financial crisis.
Plus, China scrapping COVID rules for international travelers, signaling the end of zero COVID. China stocks rallying on the back of the news.
And travel chaos. Thousands of flights canceled across the country following a deadly winter storm. Southwest Airlines feeling the brunt of it. We will discuss in a moment. But we begin today with our top story. China is dropping its COVID-19 quarantine restrictions on international arrivals. That is effective early next month, and it puts the country on track to emerge from years of global isolation. Inbound travelers will no longer be required to quarantine upon arrival, a change from the current requirement of an 8-day quarantine. That 8-day quarantine currently in place where you have to do 5 days in a hotel and then 3 days at home. That is going away for the nation, effective, I believe, on January 8th. So this is a big change, you know, and it's so interesting to me, Jared, because there has been all of this anticipation about China removing its curbs. And it's happened, I think, much more quickly and sort of abruptly than most China watchers even had anticipated.
I think abruptly is the key word here, because after President Xi had secured an unprecedented third term, that COVID zero policy just began to become unwound on a very quick basis, and we saw it in fits and starts. But you take a look at the screen there, we're seeing deaths and cases shoot up. Healthcare system is having quite the time keeping up with this. Nevertheless, you had to think this would come at some time, but there was no gradual winding down of this. I think that speaks as to perhaps the arbitrariness with which some of these restrictions were placed on initially. But, you know, in the grand scheme of things, the Chinese now have this huge experiment with a lot of data points and a conclusion that, you know, if they wanted to enact a zero COVID policy, here's how far they can push it. And I think we found out because at the end of the day, it was social unrest that really reined it in, Julie.
Yes, it was social unrest at the end of the day. Now we'll see. You know, there's this view in the markets that now that China's reopening, everything's going to be hunky-dory. At least that seems to be what's priced into stocks. But that's not really how things are necessarily unfolding. And now that's starting to, at least I should say that's what was priced into stocks, that every time you got a reopening headline, China stocks would improve. That's not gotten as straightforward as we get more headlines and as those headlines are accompanied by some of the case and death statistics that you were just talking about. And indeed, when you look at China stocks, the Shanghai Composite's down 15% year to date. That's its worst year since 2018. The Hang Seng is down 16% year to date, its worst year since 2011. So we are seeing definitely still some pressure on some of these Chinese stocks.
Yes, and I was just pulling that up on the Wi-Fi Interactive. It actually surprised me. I didn't realize that Shanghai was only down 15%. Let me show you this chart here. The Chinese market here, this is the Shanghai is an imperfect measure of the entire stock market, but it basically it bottomed in the early part of the year, the second quarter, and then it had a retest. Now you compare this with what happened with the Nasdaq, and boy, it was off to the races to the downside by the middle of the year, also making lower lows very recently. The Chinese stock market effectively bottomed much earlier before U.S. stocks, and so that's why we look at some of these heat maps. I'm going to show you the Chinese Golden Dragon components here. Let me take these overnight quotes off just so I can give you a good idea of what's going on. I'll sort by year-to-date performance and then give you, there we go. As you can see, some of these names came back towards the end of the year, but let me just show you. This is, by the way, this is year-to-date. It's surprising that any of these names are in the green, but here's what happened over the last month. So a lot of these names had been front run, so I think we've seen the bulk of the gains probably accrue to some of these early risers here, and we'll have to see what happens in the new year. But now it's really incumbent upon the Chinese healthcare system to absorb all these increases because that was a putative reason for all these measures in the first place. So we'll have to see where the stress points are there.
Yes, we will indeed. We'll also have to see how this affects global supply chains, which we're going to talk more about later in the show. We also have to talk about what's going on here in the U.S., where Southwest Airlines has already canceled nearly 3,000 flights today following a weekend of chaos as the airline struggled to navigate the Christmas holiday rush and dangerous weather conditions. The number of canceled flights for Southwest just yesterday over 10 times higher than for Delta, which had the second most cancellations. You can see Southwest shares are under pressure in the early going, and Southwest put out a statement and said they were fully staffed, they were prepared for the holiday. The problem is geography, effectively. At least that's part of the problem for Southwest. Right. As they point out in their statement, they're the largest carrier in 23 of the top 25 travel markets in the U.S. They're a big market in Buffalo, which, as we know, was one of the hardest hit areas during all of this.
Yes, and then they also have a Denver hub. I think their biggest problem is a misallocation of resources. So they were fully staffed coming into this, but then as delays grew upon delays and that kind of snowballed, no pun intended, their schedule, I guess I don't know what the right phrase to call this, the itinerary management system, the scheduling management system that they use.
It's called point to point, isn't it?
Okay.
I think that's what it's called for Southwest.
Sounds right. Anyway, whatever that system is, was not proving robust. So one of the domestic carriers really responsible for a large bulk of the population here. I think it's idiosyncratic to Southwest. Some of the other airlines didn't have nearly as many problems. You can blame geography, but at the end of the day, it looks like when you have that many problems stacking upon each other, there's probably something systemic, and that point-to-point system, as you just pointed out, probably taking the brunt of that.
Yeah, so I should say geography plus that system, and that caused that cascade of delays and cancellations. I mentioned Buffalo, and we talk about the travel system being taxed, but of course that wasn't the only system. The emergency responders in the Buffalo area were taxed. We know of at least 28 deaths related to the storm in Buffalo, some of them due to people having cardiac events as they were shoveling snow, some of them due to power loss and the temperatures just being so cold that people couldn't deal with it. The Buffalo Niagara Airport, Jared, got 49 inches of snow over a period of 3 days. Now, even for Buffalo, which is used to this kind of weather, that was just an untenable situation. Yeah, I'm expecting the White Walkers to walk out on the screen here. I'm looking at some of these images, just absolutely incredible. Haven't seen anything this quite the while. I will say, Julie, probably I ate a little bit more over the 3-day weekend than I would have otherwise, just because I was encamped within my own household. Not willing to brave the teens, this lovely weather. It wasn't that bad here in the city, I gotta say, but I didn't go out that much. No, I mean, and we didn't get snow here in the way that they did. We did get things that iced over. One more thing that I do want to mention when we talk about systems being taxed is that there are a lot of now water problems in the South because of freezing temperatures, freezing water lines, causing leaks. And so a lot of areas of the South are now under boil advisories, either because they have low pressure or there are concerns about contamination in the water. There are places like Jackson, Mississippi, that are acutely affected by that. So we got to keep an eye on that too. In other words, when we look at the economic effects of a system like this that is so widespread across the U.S., I think it's going to be a few days before we get a full grasp of the full effects of that system. Agreed. And with just a few trading days left in 2022, the S&P 500 down 19% on the year, saw its worst year since 2008, as a vast majority of stocks fell into a bear market under the weight of rising interest rates. And I'm looking at the Wi-Fi Interactive. I actually just tweeted this out a little bit earlier. I went to some of the more popular markets here, including the S&P 500. Rattling off that stat there, down 19% year there. But in 2008, it was down 38%. That was the global financial crisis, arguably worst by 2 times that year in terms of performance. XLK, that's a tech sector, that's down 28% this year. 2008, it was down 34%. You'll notice that in 2008, the overall market was down a bit more. That's because tech was not the culprit back then. But you take a look at consumer discretionary, that's XLY, down 36.5% this year. All-time worst by a small margin, was down by a similar amount in 2008. Apple, 2008 was down 57%. Now it's down about half of that, 26%. Tesla, worst all-time. Amazon down 49%, half of its value. But in 2000, when it was a fledgling stock, third year of public company, performance was down 80%, was also down the next year. So we've seen some of this before, but Julie, I know you were tracking some of the performance
forecasts
Yes.
of various high-profile members of the analyst community here, and they didn't quite get this year right.
No.
Well, as we didn't.
Nobody. I titled this this graphic. I suggested the title "Forecasting is Hard," right? Because it is to figure out where we're going to be at the end of a year, especially a year that saw, for example, the Russian invasion of Ukraine that was not forecast, that saw some of the feedback effects post-pandemic and the effects on the supply chain that, we talked about what were difficult to accurately forecast. You had a year in which the Fed thought that inflation would be transitory and it just kept keeping on. And so all of that means that the average forecast, if you go back to late November of 2021, and the forecast as compiled by Bloomberg for Wall Street were for the S&P 500 to finish this year around 4,800. The high was from BMO's Brian Belsky at 5,300. He was quite optimistic. Mike Wilson, as he's become known, was pessimistic, but he wasn't pessimistic enough at that point in time, 4,400. So it's quite interesting when we look back and sort of knowing what we know now. And obviously these folks then adjusted their forecasts throughout the course of the year, as they do. But still, it's always instructive to go back and see. And during the rest of the week, we're going to look ahead and see what their forecasts are right now for the end of next year. And then we'll do the same exercise all over again.
Yes, rinse, repeat. I don't want to say that. That kind of takes some of the luster out of what we do here. But just a quick comment on that. It blew my mind that Mike Wilson was the low ball, and it was 4,400. Now we're sitting at 3,800 and change here in the S&P 500. Just goes to show you how much things can change in 1 year here. I had one other thought here. So Mike Wilson was really a leader in the bear market case this year. And early on, too, he saw the Fed pivoting. Now, not the pivot that we're talking about here, the original hawkish pivot. Don't forget that the Fed already pivoted this year. They're going to pivot next year, maybe. But so he saw that with a lot of clarity. And then over in the I think it was Michael Hartnett over at Bank of America, really had a lot of the tactical calls going his way this year, the ins and outs, the ups and downs with the vicissitudes within the market. And then Kalanovich over at JP Morgan, this was one of his worst years in a while. They call him Dr. Market for a reason, but he was one of those guys who was buying the dip early on and didn't really leave that mantra until later in the year. Yeah,
one more thing I want to mention outside of stocks, because now going into 2023, the big call seems to be fixed income. Yes. And just a reminder that fixed income had a terrible year in 2022, whether you're looking at the corporate bond market as measured by the Ag Index, or whether you're looking at treasuries. There's the treasury total return and the negative return we saw. And that's why, just to refresh people's memories, that's why it was such a tricky year for many investors, because the usual area of refuge, which was here, was not a refuge at all in 2022. The 60-40 portfolio was not working.
Yeah, excellent comment there. Not a lot to add to that, but you do really have to consider the double whammy that was caused by losses both in the stock market and the bond market. When those two happen, it's usually centered around a huge game-changing event for the Federal Reserve, like we saw this year. So the Fed having to change course, pivot up to the upside or the downside, that usually changes the game for equities or for bonds, and then it's a double whammy for the investor returns.
Yeah, so we'll see what happens in 2023. All right, we're going to take a quick break. Coming up, where our next guest says investors should be looking for long-term performance. We'll discuss that next. As we continue to count down to the new year and look toward 2023, we welcome in our first guest this morning. Says the themes of inflation and recession will be sticking with us well into the coming year. Joining us now is Sylvia Jablonski, Defiance ETF CEO and CIO. Sylvia, good morning. It's good to see you. Happy holidays. Not a very happy holiday message, I guess, that we're going to be dealing with all this stuff going into 2023, right? But it does seem like, especially on the inflation front, that things are at least getting better or getting less bad. What are going to be the implications for the markets in early 2023?
Hi, Julie. Great to see you again, and thank you for having me. Well, look, it's not actually all bad news. I think that, where we're at today is probably where we're going to be in a couple of months, right? We have a Fed that remains hawkish. He wants to get to that 5% plus terminal rate. We'll see if he actually gets there, because a lot of the work that the Fed has done, hasn't really impacted the economy just yet. There's a little bit of a lag to that, as there is to job numbers and some of the data that they look at. So who knows? But let's take them for their word and assume that it's going to be a couple of rough months to start the year. But the good news is that inflation has fallen from a peak of 9.1% to 7.1%. It's trending lower. You're starting to see some softness in the housing market. So you do see this rolling recession that's actually happening out there. Consumer sentiment is terrible. Retail spending, although the consumer is resilient, it's starting to give a little bit. So a lot of this tells us that the Fed might not have to do as much as he says. And I think that on the other hand, though, if we have a recession, it's likely to be a soft landing, because although the numbers are softening, they remain resilient, whether it's production, the consumer, and otherwise. But the good news is, sort of the spin on this is, every single time a market falls 3 to 5%, if you're a young person, or if you're someone who has a retirement account and you're not retiring for another decade or so, these are great times to gather up stocks and create some value. So it's not all bad.
Well, let's talk about some of the areas where you might be seeing some opportunities in early 2023. I'm looking at your list here, travel stocks and some defensive names. Could you go into a little bit more detail there?
Yeah, sure. So I think when I think about 2023, the first half of the year, just based on, what I mentioned before, will probably be a little bit defensive. So I'll look at things like healthcare. A lot of these companies pay dividends. There's a massive aging baby boomer population. They're going to continue to consume medical services, pharma, biotech, things like that. And they tend to do well in recessions anyway. You're not any less sick if the market pulls back, right? In terms of the travel trade, it's sort of counterintuitive, because if we go into a recession, perhaps, people might not spend as much. But I do think we're talking 2023. If you look at the outlooks and the last earnings calls from companies like Delta, for example, and Norwegian, they're talking about doubling their revenues for the next year. They're talking about increased demand. So you sort of already have that information from them, and that the next quarter or two might be okay there. I also like alternative energy. We're talking a lot about diversification. We're talking about looking at commodities that have done well. And when you look at a space like hydrogen, for example, it's a growing area that is actually picking up some steam. So you have these companies that are building out major hydrogen, plant cell stations. We're talking about Bank of America by 2050 saying it's an $11 trillion marketplace. The Renewable Energy Agency saying that 12% of our electricity will come from hydrogen. Right now, that number is 0. So these are areas where I'm going to look to allocate next year.
I want to pick up on hydrogen. I have to admit, for people who saw Glass Onion, perhaps over the holiday weekend, there was a little bit of a hydrogen theme in there, although it wasn't necessarily a positive one. I won't go further for fear of spoilers. But what I will say is that it may get to that size by 2050, but it still feels pretty early in that space. So what do investors need to keep in mind? I mean, these past couple of years saw a burning of investors who were trying to get in on disruptive technologies. And so what do they maybe need to keep in mind when they're investing in spaces like this?
Yeah, so that's a great point. And I think, when we think about disruptive technologies, we're still thinking about companies that are around today and generating revenues, right? So while I believe that quantum computing is going to be, a massive innovation in the next decade, the companies that are just starting out in that space are companies like Google and IBM that are going to benefit from their existing business lines while they innovate, right? So it's not so much, think about this small company that's going to be, absolutely whacked by interest rates. That's sort of not what we're looking at. In terms of hydrogen, it's the same thing. It's companies like Fuel and Ballard and Plug, that have these massive contracts with Amazon to run their forklifts and things like that. But to answer your question a little more specifically, I think if you're looking at true, disruptive technology of like startups that are just on the map, perhaps just have gone public, not a lot of liquidity, they are absolutely going to suffer for the next couple of years. There's no doubt about it. They need to borrow and interest rates are going to be high. But if you're talking about innovation and disruption with companies that already exist, are quality companies, sizable market caps, the IBMs, Microsofts, Googles, Amazons of the world. For those companies, I would argue, are absolutely on sale. And, you gave some great stats before about how long it took them to kind of recoup their performance. I don't think it's going to be 2 or 3 years. I think that this is going to be, the end of 2023 when you start seeing some of these companies start to recover because they're just too good. They have too much cash and they're part of every single thing we do in our day-to-day lives.
All right, some uplifting, an uplifting tone there, I would say, overall. And thanks for that. Thanks for being with us on a Tuesday morning here. Really appreciate you stopping by,
Jared.
as always, Sylvia Jablonski. Coming up next, Tesla extending its Shanghai shutdown. We're going to discuss all that, plus the opening bell up next on Wall Street. Welcome back, and still some time before the opening bell, so let's get a dive into some of the hot tickers that are trending this morning. We're going to start with Tesla. The stock is down about 5%, as you can see there. That's after the EV maker announced they have suspended production at its Shanghai plant due to a wave of COVID-19 cases among its workers. And Yahoo Finance's Praz Subramanian is here tracking the story, joins us live now on set. Praz, what are the details here? Because we had the zero COVID reaction from the government, and now we have the opposite of it.
Yeah, so they were going to shut down for Christmas break anyway for a few days, and they extended the shutdown by a day And apparently Reuters and the journal reporting that's because they had a wave of COVID infections at their factory, but also their suppliers. So they extended that break for a day. Traditionally, they don't actually take off probably that much time during the holidays, but now they are because of, hey, demand slowing down in China. They actually have increased production at the plant, so they're actually more productive there, so they don't need to be on a lot of those days. I know we're going to come up with NIO, but I think NIO is a big reason why a lot of the shares of these EV makers are down today.
Well, and just quickly, I want to say it also feels like that people are at this point looking for excuses to sell Tesla maybe into the end of the stock has just had such a terrible 2022. Yeah,
and you have tax loss selling season, all that stuff happening right now. I mean, look, it's down 5% today. People are talking about $100 as support. I mean, it's wild how deep the sell-off has been this month in Tesla in particular. So for sure, this is a stock trending in the wrong direction, for sure.
Yeah, and you mentioned NIO. NIO also coming out this morning and explicitly cutting its production forecast, or delivery forecast, I should say. It now has said it expects to deliver up to 39,500 vehicles in this current quarter. Before this, the lower end was 43,000. So this is quite a cut for NIO also.
Yeah. A statement today facing challenges in deliveries and productions, supply chain constraints caused by the outbreak of the Omicron virus, like you mentioned, Jared, that is really hampering their ability right now. But I think a lot of it is still having to do with the fact that, sales are only up 4.5% in December in China. So you're seeing that market slow down to begin with. And then adding on top of that, the reopening and the COVID infection rate kind of rising. I think that's sort of creating this perfect storm right now for them as we enter the end of the year.
Let me go back to Tesla here for a second, and just getting to the Chinese New Year, which we have coming up at the end of the month, from January 20th to January 31st. So that's 11 days right there. It looks like the EV maker is going to be stopping output. How does this compare to how they've dealt with the situation in years past? Does this speak as to the demand situation there?
So Reuters saying that they're going to shut down for Lunar New Year. Typically, a lot of other automakers will do that, but Tesla hasn't done that. Typically. So this year they're going to have an extended shutdown in January, saying they're going to do some maintenance in the factory there. But I think it's something like almost 10 days they're being shut down in January for the holiday. So it's a lot for them. They're going to maintain their, they call them the plug wiring harness. They're going to keep making those different like EV parts there, but not actually assembling vehicles at that time. So it's hard to say if this is actually a thing that they want to do going forward, and that's matching what the industry is doing, but it hasn't been what they've been doing in the past in terms of shutting down production in Shanghai.
Pras, thank you so much. Appreciate it. And obviously, 2023 is going to be a really pivotal year for Tesla because of what has been a crazy 2022 for the company, and not just the company, but for Elon Musk with his acquisition of Twitter, and then the implications that has had for sentiment surrounding the stock. So we've got just a couple minutes here or about a minute to the opening bell here on this Tuesday morning. We've got a mixed picture as we head towards the opening bell, and as Pras just alluded to, you mentioned the tax loss selling that could be affecting Tesla. Certainly this last week of the year tends to be a low volume week. You tend to see some kind of wacky moves because it's not necessarily fundamentals that are driving things. I
think so. We already had our highest volume day of the month, likely. I mean, we don't know that until it's over, but that was options expiration. That was S&P 500 rebalance. That was a week ago. And there's really not a lot of space in the market, not enough liquidity to absorb any market changing information. So in the very unlikely event that we were to get something that was uber hawkish or uber dovish from a Fed official, can't imagine what that would be. It might throw things out of whack, but we're not expecting any huge changes this week. So we do have to take a change in the official narrative. And here's the opening bell. Looks like we got, not seeing exactly who that is over at the opening bell. Make-A-Wish Foundation. And it looks like stocks are opening up. I'm not sure if they're mixed, but we did have a mixed board going. Yes, it looks like the S&P 500 down just about 0.2%, Dow down 0.25%, and the Nasdaq down about 0.2%. And let's get over to Julie Hyman standing by at the Yahoo Finance Interactive.
Here I am. And indeed, we are seeing this mixed picture at the opening bell. Even the S&P is actually opening up a little bit lower, which the futures were not pointing in that direction. The Nasdaq kind of following on the trend that we have seen so far this year, where it is the worst performer of the three major averages. And it definitely has been interesting this year, right, that we have seen this underperformance of the Nasdaq pretty dramatically, down 33% now year to date, where we have seen around a 19% pullback for the S&P 500, for example, year to date. And as we get underway this morning, I also want to take a look at what's happening with the various sectors within the S&P 500. Energy and materials doing the best here this morning, and then we've got consumer discretionary and tech. So sort of cyclicals doing poorly, although you would consider energy a cyclical too. But that's what we're seeing. Also want to take a look at the Nasdaq specifically, since that is the underperformer, and take a look at the Nasdaq 100. There we go here. Tesla, as we just pointed out a moment ago, dark red here, down 4%. And we were just talking about its year-to-date performance as well. So now it's down 66.5% for the year-to-date for Tesla. If you look elsewhere here, we do have the likes of Amazon and Alphabet and Microsoft and Apple all lower, but their declines are much more muted. And there's actually quite a bit of green on the screen here for the Nasdaq. So we'll see how that shakes out as we get further into the session here. But even as we get out of the gate here, now the Nasdaq Composite is down 0.4%, Jared.
Wow, Tesla down 2/3 this year alone. And we want to get to AMC. That's also trending this morning. The stock is down 7.8%. That's hot off the news that was last week that the company is planning to sell stock to a private investment firm. The movie operator now announced a $110 million equity capital raise and said it was seeking a 1-for-10 reverse split of its common stock. And we were talking about this last week, Julie. I'm going to load our meme page on the Wi-Fi Interactive here just so we can see what's going on today. And let me sort by performance. It doesn't look like we have a lot of green here. I'm seeing out of the corner of my eye more red than green. At the bottom of the pack, we have AMC, the Class A shares. That's down over 7%. And then meanwhile, in the upper left, we got those ape shares. That's up 15%. We're covering that because of peculiarities in the way share classes are constructed, because of the fact that the company could not authorize any more Class A shares because they didn't have the votes for it. Well, they had to do this. They had to create these ape shares, and now they're trying to equalize them. So that's what's going on there. We take a look at 5-day performance. We're going to see, my guess is, we're going to see ape shares up 200%. That's as they kind of come back into parity with the Class A shares. So some math going on there, but not a whole lot of fundamental news.
Well, that is not unusual when we're talking about this particular company. And we've also talked about that AMC shares are now back below where they were before the meme stock craze began. So that's something that we saw happen last week, and that movement does continue. So we'll see what happens with on the retail investing front going into 2023. That's something else that I'm going to be watching quite closely, the flows of those dollars and where they're going.
Yes, I'm going to be the story of how the retail investor has coped with the pandemic, with the stimulus checks, having seen a lot of those gone up in smoke in crypto and meme stocks. I find the plight of the retail investors, those who are still sticking around, to be an incredible story. It's always fascinating to me who's coming into the market at various times. And the retail investors, in my opinion, have not been through a harder 2 to 3 years than they have in the last 3 years. So anybody who's still standing around for 2023, it's all upside from here, guys.
Let's hope.
I hope.
All right, coming up, we're going to take a look back at this year for the SEC, the Securities and Exchange Commission. That's on the other side of the break.
From bringing the biggest lawsuit on fraud in crypto history to new rules for the stock market and climate regulations, the Securities and Exchange Commission will be remembered in 2022 for proposing landmark rules, but also for actions it did not take. The SEC proposed the biggest changes to rules for the U.S. stock market since the mid-2000s, prompted by the GameStop meme stock frenzy in 2021 that saw online brokerages and market makers struggle to handle huge volumes of stock trading. The new rules would change the relationships between brokerages that take investors' orders to buy or sell securities, high-speed traders that handle the orders, and stock exchanges. The aim? Create competition for investors' orders to lower prices while increasing oversight of market makers.
It's about driving greater competition, transparency, and efficiency in the marketplace. And we have a marketplace today that, depending upon the day, between a third and a half is not in what's called the lit markets, but is in the dark venues, dark pools, or just being purchased by wholesalers. So it's trying to consider recommendations to better level the playing field between these venues.
Meanwhile, more than a decade after Congress passed the Dodd-Frank Wall Street Reform Law, the SEC approved a rule to claw back executive compensation of companies that have had to materially correct financial statements. And in a first of its kind, the SEC proposed requirements for publicly traded companies to report information on greenhouse gas emissions and risks related to climate change. But a decision by the Supreme Court to curb Environmental Protection Agency's power to regulate greenhouse gas emissions has thrown into question whether the SEC could impose climate rules. Finally, 2022 was a year that saw major enforcement action from the SEC against crypto firms. But it was also void of new rules tailored to crypto, causing members of Congress, the crypto industry, and others to blame the SEC for the meltdown of crypto exchange FTX. The SEC has filed a lawsuit against FTX founder Sam Bankman-Fried for defrauding equity investors to conceal using customer funds to support his hedge fund, Alameda Research. When asked during a recent interview whether it was finally time to write rules tailored to regulate crypto, SEC Chair Gensler wouldn't say. Instead, he said existing securities laws are in effect and that the agency will enforce them. This year, the SEC levied a $100 million charge against BlockFi for failing to register its retail crypto lending product, a record fine against a crypto firm. The agency also fined Kim Kardashian for touting a crypto security on social media without disclosing she was paid to market it. Gensler's goal for 2023? Making crypto exchanges and lending platforms come into compliance.
They can do that appropriately, working with the SEC, or we can continue on the course with more enforcement actions, and I would have to say that the runway is getting shorter.
All right, let's bring in Yahoo Finance's Jennifer Schonberger now. Jen, so as we look ahead to 2023, what's sort of the biggest things on the SEC's docket?
Hey, good morning there, Julie. Crypto is going to be very closely watched in 2023. You saw Chair Gensler send a warning shot for more enforcement action. Certainly, they are suing FTX's founder, Sam Bankman-Fried. They are also going after other people close to him that were involved in management of that company. So we should expect to see perhaps more lawsuits coming out in that area as well. Most of the regulatory effort is not likely to be in rules that are tailored to crypto that are newly written, but rather through enforcement action, which is what Chair Gensler seems to be signaling.
Jen, thank you so much. I appreciate the look back at what was an interesting year for the SEC for sure.
It was a momentous year indeed, yes.
Yes, thanks, Jen. Coming up, how shoppers spent their money this holiday season. We'll break down the results of MasterCard's Spending Pulse survey. That's next.
Welcome back. Holiday spending was on the rise this year with MasterCard's Spending Pulse survey showing a 7.6% jump in total retail sales. That's between November 1st and December 24th, excluding autos. MasterCard senior advisor and former CEO and chairman of Saks Inc. is Steve Sadoff. Steve Sadoff joins us now to break down the report. Steve, thank you for joining us here. Looking at the headline numbers, total retail ex-auto up 7.6%, in-store 6.8%, online a 10+% jump from last year, but not increases across the board in every category that we're seeing.
Yeah, Jared, I think that's a good description of it. This was a very solid holiday season. 7.6% was right in line with what MasterCard had forecast for Spending Pulse. And remember, this is across all forms of tender, including cash debit. So this is a perspective on what really happened during the holiday season. I would describe the number as solid, but a little bit different than some people had thought coming into the season. It was more online. Online had been not growing nearly as fast. Remember, we had rapid online growth in the beginning of the pandemic. And over the last early part of 2022, it slowed dramatically. You saw a resurgence of the online shopping. It was a more promotional environment than a lot of people thought. There was the excess inventories that were sitting in the system. Much of that got discounted during the holidays. So part of the story is yet to be written in terms of what happens to margins. It was a more experiential holiday season. You saw it in the restaurant numbers, people wanting to get out. So you've got that pent-up demand for experiences that are driving some of the behavior. And I think you see a slowing environment versus what you saw in the summer. In the middle of the summer, the growth was 10 to 12%. Now we're looking at 7.6%. So while a healthy number, it's clearly recognizing a slowdown, and we're in an inflationary environment. So that's eating up and contributing to a lot of the growth.
Hey, Steve, it's Julie here. It's good to see you. I want to zero in
Julie.
on that in-store number in particular, which rose, but is a lot lower than some of the earlier forecasts from earlier in this season. What do you think is going on there? I mean, listen, I went to the mall a couple times over the holiday season, and it was packed, but I guess that wasn't true across the board.
Well, first of all, I think 6.8% is a very solid number. So you had historical declines going on in the in-store prior to the pandemic. So I would characterize as not a bad number at 6.8%. Again, much of it inflation driven. It was, I think that there were spurts early in, this was an early season. Remember, Amazon had a second Prime Day in the middle of October. A lot of the big retailers followed. So there was a big burst early in the season. You also saw a very big burst right around Thanksgiving. The Black Friday, Cyber Monday was quite strong. And then you had this big lull early in December, and then a very good recovery at the end of the season. Now, part of that is the consumer focusing on value and picking up some really good deals. But I think that the in-store numbers at that kind of level was reasonably healthy relative to the longer-term trend. Right now, I think, Julie, what's going on is I would call it a reversion to the norm. And we're seeing these variations early in the pandemic, the big wins by the stay-at-home categories. As you came out of the pandemic, the experiential categories, we're seeing some very big increases. You see it in the restaurant numbers. But now we're starting to ease back towards a little bit of normality, because if you look at it versus 3 years ago, the overall growth among the categories isn't that differentiated, other than some of the restaurants really seeing some good performance. But when you see declines on jewelry, for example, that's against a very high number a year ago. So, or electronics, where everybody bought their television set early in the pandemic. So I'm a little bit less concerned just on the year on year as I am looking at the longer term trend. Department stores at 1% is a slowing from where they had seen earlier in the season, early mid-year. They were seeing some bigger growth numbers. So I'd be looking at that. That's getting back towards that secular declines that they had seen prior to the pandemic. So again, experiential is great, but you've got to deliver on the consumer experience. Otherwise, these trends don't stay together longer term.
And Steve, 2022 is a year that both, I guess, the average consumer as well as business owner were rocked by inflation. And we saw inflation expectations and actual inflation explode to the upside. We're expecting, well, there are some expectations of a big decline next year, or at least a modest decline. Just wondering how some of the retailers have adjusted their margins to deal with this new norm, and which hopefully is not a new norm, but we may have to take it as such.
Well, I think inflation has been a massive issue for all of retail and for consumer brands. I think the winners have been the ones that have been having pricing power and be able to pass on their cost increases to the consumer. As inflation, supply chain costs wane, you're starting to see a slowdown in some of the commodity cost areas. You're getting a major degree of resistance from retailers to accept price increases right now. I think that as we go into 23, you're going to see less increases passing through from the brands to the retailers. And I think that you're going to be in an environment where it's going to be about differentiation. Now, the inflationary impact really varies from category to category. If you look at food, we've seen close to double-digit inflation, and a good part of the increases you're seeing in grocery and restaurants are driven by that inflation. If you look at other categories like apparel, where you're seeing a lot of excess inventory that's being discounted, I actually don't think you're seeing as big an inflationary impact because of the depressing effect of the discounting. So the inflation is really going to vary from category to category. And I would anticipate that as retailers get their inventories in line, because you're still not at a point where inventories are in line because of the dislocation and the wrong categories being bought too heavily, I think you'll see a little bit less inflationary pressure because there won't be as much discounting going on. This was a very different year because of the amount of discounting.
Yes, it has. We've all been watching the inbox indicator very closely, Steve, how many sales we've been getting in our inboxes, and there's been an uptick for sure. Thank you so much for joining us. Happy holidays and Happy New Year to you. MasterCard Senior Advisor and former CEO and Chairman of Saks, Steve Sadov. Thanks so much, Steve.
Thanks.
Coming up, box office breakdown. Which films scored big this holiday weekend and which did not? That's next. Disney's Avatar: The Way of Water is nearing $900 million in global ticket sales following the long holiday weekend. Our Alexandra Canal joined us now with the details. Allie, how much did weather affect the ticket? Because the gross for the first weekend it was out was kind of disappointing. So did this make up for that?
You know, box office analysts seem pretty encouraged by this number. Certainly the intense storms, the weather that we saw across the United States did contribute to a dip in overall moviegoing, but still domestically, according to Box Office Mojo, the film has grossed roughly $287 million. Per deadline, that number could jump to as much as $294 million once we receive the official results from Monday. A lot of folks off of school, off of work, so there is some encouraging signs that we could even see higher levels after the results from yesterday. And then internationally, the film grossing roughly $600 million overseas. And we always knew that the international box office was going to be a big driver for this film, very similar to the original Avatar. And these numbers actually make this film nearing $900 million, the fifth highest grossing film of 2022. And if we take a look at the top four, you'll see Top Gun Maverick high and above the rest, about $1.5 billion there globally. That was followed by Jurassic World Dominion, Doctor Strange in the Multiverse of Madness, and then Minions: The Rise of Gru rounding out the top four. So the sequel, I will say, for Avatar is outpacing the original film, and that went on to become the highest grossing movie of all time. So there are those signs that we could see more sustained momentum, especially as there's not that much competition. The next big movie is the new iteration of the Ant-Man franchise coming out February 17th. So from now until February 17th, it's pretty much just Avatar, but the film is roughly less than half of what it needs in order to be profitable. So James Cameron and Disney are hoping that, you know, word of mouth can sustain it over time.
And just real quick, this is just the first in a number of planned sequels and at least another one is already shot in the bag. Is that right?
Exactly. At least another one is already shot. I mean, it's been 13 years in the making for this sequel, so there was some concern that maybe people weren't as interested as they were in the past, but it seems like, at least right now, people are curious. They want to see it. The visuals have been amazing. There's been some question marks about the plot points, but overall, I do think people are going to go out and see this movie.
So when you talk about no competition between now and February 17th, really in the theaters, there's a lot of competition at home, right? And that's really the big differentiation point between now and when the last Avatar came out. One of the things that's competing for people's attention was Glass Onion, which was I guess you could call it the Knives Out sequel, although I was just reading that the director of the movie and the creator of the movie said he didn't even like that it said Knives Out on
like,
the
this
title
is its
of the
own
movie because it just has one character that carries over, the detective. But do we have any indication as to how that did yet?
Well, Netflix is going to release its top 10 list later this afternoon, so we'll find out exactly how well this film did then. But I do think we're going to see Netflix brag about this movie during its fourth quarter earnings review. The actual reviews on Rotten Tomatoes has been very strong, a 93% critic and audience score. The film was released in limited theatrical markets over Thanksgiving weekend, and although Netflix did not release the exact box office total, industry estimates had it placed at around 13 million. So there was a lot of talk that Netflix potentially left money on the table by not having a longer, more expansive theatrical release. And this film could be a critical turning point when we think about how streaming companies view the box office, that relationship with the box office. How can it leverage it in order to monetize more effectively? Because we're in this moment that Wall Street has been super critical about all of these media companies. Are you generating a profit? Are you, increasing your free cash flow? Box office could potentially be a good hedge against that, although Netflix has been very staunch in the fact that their streaming movies are just that. They're for streaming, but money talks at the end of the day.
They got my eyeballs, so that's a feat. I didn't watch a lot of shows over the holiday weekend, but Knives Out was one of them.
Everybody on our team saw it.
Yeah, and if you weren't going out to the movies due to this weather, chances are you're on your couch and you're scrolling on Netflix. So.
Yep.
All right, Allie Canal, thank you for that. Coming up, Baird's Michael Antonelli. He's going to share his top 3 predictions for 2023 up next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Jared Blickery. Brian Sozzi and Brad Smith are off today. Markets are in the red this morning. We started out mixed, but now it looks like things have taken a little bit of a turn for the worse. Investors bouncing between anticipation maybe of a Santa Claus rally and continued gloom from the year. Of course, reduced trading volumes and a shortened final week of trades might mean the week is not a good indication of what's to come in the new year. We'll break it all down for you in this hour. And here's what else we're serving up this hour. Hope in the home builders, why stocks like Lennar and KB Home are outperforming the S&P 500 since June, how interest rates and incentives are shaping that trajectory. Retirement gets a boost. A new federal spending package could mean a matching contribution of up to $1,000 per person for some lower income workers. We'll give you the details. And New York Representative-elect George Santos admitting to falsifying key parts of his biography, including his claimed work at banks like Goldman Sachs. All that and more coming up later this hour. But first, let's get over to Jared at the Wi-Fi Interactive as we've had this turn for the worse in markets.
Yes, all three majors underwater right now. So is the Russell 2000, and the Nasdaq is actually taking it on the chin the most. It's down 1.5%. Here, the S&P 500 is down about 0.8%. And this is actually day two of the Santa Claus rally. It's officially only the last 5 days of the year, trading days of the year, plus the first two of the next year. So we got 3 and change, including today. And here we see the S&P 500 now negative on this 2-day time frame. Dow is slightly above water, up about 18 basis points. And the Nasdaq, the tech-heavy Nasdaq, down over 1%. And that has been par for the course. Kind of the story throughout 2022. This is a very good encapsulation because guess what? Energy is positive here today, up 0.5%. Here's the year-to-date totals here. Energy up 57% for the year. Nothing else in the green. So as I said, kind of representative here. To the downside, tech is a worst performer, followed by communication services and consumer discretionary. All three of those, by the way, are the mega cap laden sectors. You can see Tesla down here, 6.5%, Nvidia down 4%. There's a little bit of green on the screen, but it's mainly centered in the consumer staples. That would be some of the defensive names. We see PepsiCo just barely trying to break even, Mondelez break even, and also KHC. So really not a lot of green on the screen other than some of those defensive names, Julie.
Yeah, interesting, and sort of what we've come to see frequently in the markets here. It's expected, of course, to be a slow week on Wall Street with a lot of attention on anticipation for 2023. But let's talk about the week ahead with Yahoo Finance's Alexandra Semenova. Alex, there are people here trading this week, right? There is stuff that's going on. So tell us what we should be looking for.
Yeah, so for the few that are still at their trading desks, the economic and earnings calendar will be really light this week. So the focus will be on the price action in the final 4 trading days of 2022. Whether we'll get a Santa Claus rally or not is, of course, the big question this week. As a reminder to viewers, this is a seasonal rise in the stock market in the last 5 trading days of December and the first 2 trading days of the year. The term was coined in 1972 by Yale Hirsch, the creator of the Stock Trader's Almanac, who first observed this seasonal pattern. Now, hopes have been dampened that we'll get a year-end rally this year because of concerns around inflation, higher interest rates, and a looming recession that have rocked the markets much of December. But Friday marked the technical start to the period, and we did see stocks end with some modest gains. Stocks are, of course, under pressure today, but it's not a lost cause just yet if they're able to change course. Still, though, it's been a brutal month and year for equity markets, and year-end rally or not, stocks are still headed towards their worst year since 2008. It would take a holiday miracle to avert that reality. Now, much of the business world is off for the rest of 2023, so not much going on the agenda, but those who are still here will get readings on wholesale and retail inventories, initial jobless claims, and this morning's Case-Shiller Home Price Index, of course.
All right, now, Alex, you mentioned the Santa Claus rally or the SCR. What I like about this, it's not only the ability to tell you, well, okay, there's a seasonal probability for this specific time period, which is admittedly pretty narrow here, but it can also indicate what's going to come in the year ahead. So the 2023, that's a big basket there, but what does the SCR tell us about that?
Yeah, exactly. So this rally has been seen as an indicator of performance for the year ahead. The S&P 500 has historically underperformed in January and the following year if a rally failed to happen. Yale Hirsch even famously prophesied, if a Santa Claus rally should fail to call, bears may come to Broad and Wall. And even if we do get a Santa Claus rally this year, it won't offer much relief to equity investors. Rates are still expected expected to go higher and stay higher next year. Most banks expect the S&P 500 to go nowhere, or at least not very far. And based on historical data, the S&P 500 has also had a meaningfully better win rate the following year after a down year if declines were less than 10%. The S&P, of course, closed more than 19% lower on Friday, so not looking so good for 2023 so far.
No, definitely not, and a lot riding on this week, though, so we'll see what happens. Thanks so much, Alex. Appreciate it. Let's continue our conversation now on what to expect in the coming year of 2023. The Fed set to pivot away from hawkishness next year, but the turn in policy comes as the market finds itself in a very different place from the staggering growth we saw in the decade starting in 2010. Here with more is Michael Antonelli, Baird Managing Director and Market Strategist. And Michael, you're stepping out in front of it, I guess, and offering some predictions. Always risky, as we know, but they are important to do and also can be fun to do. So your first prediction for the next year does have to do with the Fed and its timing. Talk me through what you expect.
Yeah, definitely going out on a limb here. Predictions are part of a strategist's job, but ultimately, just trying to make really good guesses, trying to make really good probabilistic views. So I think the Fed's done hiking at the next meeting. This is a little bit out of a little bit out of consensus. I think they're done at the next meeting. That would be the Fed 1 meeting. I think they're going to end at 450 to 475. I think that's where they'll end. We're at 425 to 4.5 right now. So that's a 25 basis point hike. And I think we get one more CPI report. I think that will be enough for them to say, okay, we need to see what the effects are of these hikes. So that's my first kind of prediction for next year is that one more CPI report, one more Fed hike, and then they hit the pause button.
All right, Michael, by the way, great to see you here. Got to get to prediction number 2, and this has to do with yields and inflation. Now, a lot of analysts for over the last month or two been tripping over themselves to declare the end of the bout of inflation, say it's going to come down precipitously. Some not so much, thinking that they'll fall fast. But if inflation does fall, what happens to yields? Because I think that's the crucial differentiator here.
Right. So my second prediction kind of goes around yields and inflation. I do think inflation falls. I think it continues to fall for all the reasons that we've already seen it falling. Auto prices, commodity prices, oil prices. Remember, shelter lags will start to get that shelter decline next year. So that's when inflation, I think, really starts to fall. I think yields stay high, which is that I don't think as inflation falls, we see yields just go down with it. I think what you're going to see is yields kind of stay higher. And that's a good investment thesis, I think, for individuals next year. So look into the bond market. Is there anything I'm missing from the bond market? And if I'm right and yields stay high and that kind of 2010s mindset of low yields doesn't come back, then, FANG stocks aren't all that interesting either, right? Now you're looking at those tech stocks and saying, maybe I can't hide out in those and just wait for the market to go higher. I think exploring the bond world will be my second prediction next year. I think a lot more people will be doing that.
Yeah, certainly a lot of people have been talking about that, Mike. The other thing that you're looking for is gains in stocks in 2023. You're not alone there. The average forecast I'm looking at is about 4,009 for strategists surveyed by Bloomberg. So a gain, but another sort of meh year expected.
So the stock market, it's very rare for it to go back-to-back negative. Very, very rare. It's only happened a couple times since the end of World War II. It didn't happen after 07, right? 07 was a terrible, terrible year, and it didn't happen after then. So I'm playing the odds here. The odds of any given year being positive are about 78, 74, 75%. So I'm playing that. I do think that, again, the stock market's all about, are things getting better? Are things getting worse? I think they will get slightly better next year. I don't think we get any big gains, but I do think next year will be somewhat positive. And again, that is almost playing the odds more than anything. It's not really playing a macro theme. It's playing a theme that it's very rare for the stock market to be negative 2 years in a row.
All right, Michael, before you go, and we got time for one more here, where do you see the best opportunities for the new year? Any particular styles, sectors you're liking based on the setup right now?
I still like defense. I think defense is a great sector that's got tailwinds to it that are kind of geopolitical, that aren't necessarily about rates or yields or anything like that. And I also do like housing to come back. Housing is one of those things that you might say, why would you do housing when rates are high? There's just kind of a real endless demand for housing, and we're going to have to meet that in this country. So I would stick with housing, and defense would be my two for next year.
All right, really appreciate you stopping by here. Michael Antonelli, Baird Managing Director, Market Strategist. Thank you. Coming up, a new Twitter hack that claims to impact millions of users. Julie is back with that, plus more top headlines that you need to know. Up next. Welcome back. Walgreens Chief Clinical Trials Officer Ramita Tandon spoke with our very own Yahoo Finance's Anjali Khemlani earlier this month on Walgreens' new avenue into the healthcare space with the launch of its clinical trial business this past summer. Let's take a listen.
Yeah, you know, at Walgreens, we're on this exciting journey as we move into healthcare and create this healthcare continuum and deliver, healthcare services at a local level. And we launched our clinical trials business in June of this year, a tech-enabled business, and really part of this complete healthcare continuum. And, clinical trials is something that, over the past few decades, very nuanced in the research enterprise ecosystem. But less than 5% of the US population participates in clinical trials, and 75% that do participate are Caucasian. So we believe that there's a tremendous opportunity, leveraging the Walgreens scale, the footprint, and the trust that it has established in the local communities as an opportunity to really disrupt how we deliver clinical trials into our local communities. So our goal as we've launched this business is really trying to bring trials into communities that have never had access before, and really part of the broader mission for Walgreens, again, as we move closer into healthcare and deliver healthcare into our local communities.
Right, and for those who don't know, normally it's through a provider or an established clinical site, a facility that tends to host these clinical trials, funded largely by the government or a sponsor. So that's really interesting as well, because it sort of shifts the dynamic of your relationship with these drug companies. Do you have some insight on what kinds of clinical trials you'd be sort of limited to just based on the availability of facilities and resources?
Yeah, it's a great question. So, the typical approach is, as you mentioned, is that, most providers are asked to support manufacturers in the clinical trial ecosystem, and it's to find patients for trials. And oftentimes we know, providers and other practitioners, whether they're part of AMCs or their individual practices, can be extremely busy. And to put a clinical trial on top of busy practitioners can be quite burdensome to some extent. And so our goal is two-front. Number one, Walgreens serves roughly 120 million, 130 million lives that visit our stores and pharmacies on a regular basis. So we want to make sure that as we bring trials into communities, we are finding the right patients for trials, particularly in communities that have never had access to clinical research before. So number one is to help manufacturers find patients a lot faster. And we're using technology to enable that workflow. And it allows us to be more precise in finding patients that have the right disease conditions, the demographics, and the overall background, and match those patients to trials. And when we find those patients, our goal is to make patients feel comfortable to participate. Now, we know today there are a tremendous amount of barriers for patients to participate, whether they're travel barriers, language barriers, even medical or digital literacy. And so our goal is, how do we make patients feel comfortable, but more importantly, make trials more accessible and convenient for patients to participate? So what we have done is leveraging our physical footprint and converting our stores and pharmacies as clinical trial centers. Now, we recognize if we give the opportunity for a patient to come into their local pharmacy, have an opportunity to talk to a pharmacist, to learn more about clinical trials and to be educated and feel more comfortable, and perhaps start to remove some of those barriers or preconceived notions about clinical trials, it's one step further to make it more convenient and improve the experience level for a patient to participate. So we're using our physical footprint as an opportunity for patients to come in and get clinical trial visits completed. Now, some of the services that we're able to provide are, the low complex services, so screening, diagnostic, and some blood draws. And we recognize that, in the ecosystem, we're not here to displace the provider and that patient relationship. In fact, that is a very vital relationship that exists. But we at Walgreens want to help enable and support that ecosystem so patients don't drop out. And in fact, they can come into their local Walgreens, get a normal follow-up visit completed, and keep that patient in the trial and start to improve the overall retention rates on a clinical trial.
So that's a really good differentiator to point out. It's not necessarily that you'll be full on conducting these trials or being part of that protocol, but in the immediate follow-up after delivery, because I know some of these things can be pretty complex, like infusions. I can't imagine that Walgreens is yet at that stage to be able to support that. But is that a long-term goal? Is it, because you are doing some build out, do you envision as, the company gets deeper into healthcare that this is going to be an area where you can even build out to have more robust, tools, medical tools and the like to be able to use for clinical trials?
Yeah, as we at Walgreens continues to build out our healthcare continuum service footprint and start to understand what our communities need, certainly it's something for us to continue to think about. But today, as we partner with a number of healthcare systems across the ecosystem and across the nation, our goal is to become a support mechanism for healthcare systems or other providers so that ultimately patients feel comfortable to participate and as well as, carry forward with the trial obligations. But certainly something for us to think about as we carry forward and we start to listen and learn and understand how the patients are feeling as they start to move through this process. And as we start to get more data, certainly we'll start to expand that footprint and the types of services that we can deliver under a clinical trial ecosystem.
Talk to me about the support for this, resources and the like. Does this come directly from the trial sponsors, or are you partnering with the providers themselves? Where is that dynamic in play?
Yeah, good question. We have made some significant investments, both from a real world evidence perspective, where obviously, we have tremendous amount of information on the patient's pharmacy records. Through a partnership, we have access to clinical records, both structured and unstructured data. So we certainly have in-house staff that can help to analyze the information and start to help us understand the right patients for trials. And as we think about the trial conduct, we have created a centralized operations team that consists of project managers, clinical study coordinators, people that are well-versed in the clinical trial conduct, and to be able to support, whether we support on-site. So if a patient comes into our local pharmacies, we'll have staff available on-site. But also if a trial warrants more of a virtual or a hybrid model, we have the opportunity to digitize and use telehealth, and certainly our staff can support from that mechanism. And then finally, from a home healthcare, we certainly have some trials that warrant aspects of the clinical trial visit to be done at patients' homes. And certainly with our acquisition with CareCentrix, it allows us to mobilize efforts and deliver trial activities at a patient's homes. So we have certainly brought on a number of talent from the industry that understand the clinical trial space and can support the conduct. And certainly as we look to partner with providers, as we leverage physicians to help support the oversight of these clinical trials, we certainly do have a number of partners as we bring on board physicians to help support in this workflow.
Let's get to some other business headlines that we are watching right now. There is a potential alternative to the overdose drug naloxone that could come to market as soon as early 2024. The Food and Drug Administration has granted priority review for use without prescription for a drug called Revive. Harm Reduction Therapeutics, the maker of the drug, it's a nasal spray formulation that's called Revive, had 3 times higher concentration in the blood of 36 participants than when naloxone was delivered as a shot. And that company expects to hear from the FDA regarding the approval of Revive by April 28th of next year. If that approval does come through, the drug could indeed launch in the U.S. by early 2024. Data of nearly 400 million Twitter users allegedly hacked and now up for sale on the dark web. The hacker claims the stolen data includes important information such as users' names, emails, and phone numbers. The threat actor put out an offer for Elon Musk and Twitter to purchase the data exclusively. According to Bleeping Computer, the hacker is setting a price tag of $200,000. However, if an exclusive purchase is not made, copies will be sold to multiple buyers for $60,000 per sale. We'll continue to track that developing situation. Congressman-elect George Santos admits to lying about his education and work experience during his campaign for a seat in the U.S. House. Mr. Santos confessed to the New York Post and radio station WABC that he never worked directly for Wall Street firm Citigroup and Goldman Sachs. He also admitted to never graduating from any institution of higher learning, despite having said that he went to Baruch College and NYU. However, on the other hand, Santos says he's not committed any crimes. He still intends to serve in Congress. Coming up, why our next guest says home buying demand remains strong despite an elastic market. We'll discuss next.
Welcome back. Looking for hope in housing. Homebuilder stocks averaging returns greater than the S&P 500 over the last 6 months. This despite negative headlines. But will the market continue to outperform as the Fed, which is watching for a cooling housing market, keeps its foot on the brake? Joining us now for more, John Lavallo, U.S. Homebuilders and Building Products Equity Research Analyst at UBS. Thank you for joining us here today. First, your big picture assessment of the industry in a year that has been rocked by interest rate volatility.
It's been a wild ride for sure. I mean, we launched coverage in January. The stocks were down 20% at the time, and they continue to go down a lot further, as you know. Interestingly, as you alluded to when we opened, since November, which is the start of this sort of seasonal hope trade, stocks are up about 13% versus the S&P up about called one-ish percent. If you go back to when the stocks sort of troughed in June, they're up about 30% versus the S&P up about mid-single digits. So they've really rocketed back pretty sharply. And I think it's really a function of the market finding a bottom. I think we hit the bottom for new home sales in July at about 543,000. And I think that, we're going to slowly get better and better here. Now, it's going to be a tough ride. Interest rates are going up, as you mentioned. The Fed is content on raising rates and really kind of stifling inflation. So it's going to be challenging. We think that new home sales and housing starts will be down next year, but it's a much different story for the stocks, which are already discounting a lot of this bad news, in our opinion.
This is a really interesting thesis, John, because certainly it doesn't, for lack of a better word, it doesn't feel good, right? What's going on in the housing market, right? And it feels like it's going to be kind of rocky for a while. I mean, we got some numbers on pricing this morning, And it seems like there's definitely the supply-demand situation is still very much not in balance.
I think it's a great point, Julie. Look, I mean, I would argue that the supply-demand imbalance is very much out of whack in the sense that if you go back to the global financial crisis, we were underbuilt by, call it, 3 to 4 million units. Now, things have slowed for sure over the past 3 or 4 months, given what's happened with the Fed. But we think that that underlying demand is still there, and it's very evident when you see things like rates pull back 40 to 50 basis points, and November new home sales are at 640,000, which is a really good number. But you're right, the data is mixed. Housing sentiment is not good. Housing starts were lighter than expected. The home prices were a little bit softer than we expect. I think what's interesting, though, the bear case is really assuming that home prices crack and go down, in the neighborhood of 20 to 30%, similar to what we saw during the global financial crisis. We think that, supply is way too tight, and underlying demand is still much too stable for that to happen.
Could we delve into that a little bit more? You've mentioned the global financial crisis a couple times here. Just what are some of the key differences? I would note one is probably you don't have the massive retail speculation in properties the way we did 12 years ago or 14 years ago leading up to that. But maybe some of the secular demographic tailwinds that we have from millennials and Gen Zs trying to find homes with burgeoning families. Could you speak to some of those as well?
Yeah, I think that's right, Jared. Look, I mean, there's a strong wave of millennials coming through the pike that are reaching prime home buying age, call it between 30 and 35 years old. That is really strong underlying support. This first-time buyer is very need-driven, need-based, if you will, where if they can buy a home, they will. If that means moving a little further out from the city or buying a smaller footprint or borrowing money from mom and dad, they'll do it. So I think that, there's a very strong underlying sort of core demand element. And then on top of that, as you mentioned, the differences between the global financial crisis, there were 10 months of supply of inventory on the ground during the global financial crisis. There's 3 months today. That's and put it for context, the average is about 6 months. So we're way too low on the supply side. And I think on top of that, you have just this element of, more mortgages were kind of issued during the global financial crisis that were floating rate mortgages that adjusted very quickly, call it in a year or two, which resulted in a lot of foreclosures and a lot of more supply coming onto the market. So it's a much different ballgame today than it was back then.
John, are you recommending to investors that the home builders in general should be bought, or do you think some are better positioned than others?
Yeah, good question. I mean, I think I would love to tell you that there's differentiation right now, but unfortunately there's not. I think the group is trading, very much as sort of one stock, if you will. So I think right now you're probably best served buying the biggest and the best, most liquid stocks. That would be the D.R. Hortons of the world, Lennars of the world. I think that you'll be well served playing those names. However, I think as the recovery continues, then there will be some nuance and it'll be an opportunity to be a little bit more selective. But right now, I think, even playing the index is probably a fair way to think about things right now.
Well, we'll catch up with you in a bit then and see how it all plays out. John Lovallo, U.S. Home Builders and Building Products Equity Research Analyst at UBS. Thanks, John.
Thanks for having me.
Coming up, how the latest government spending bill could affect your retirement. We'll discuss that next. Almost 60% of U.S. households had no retirement accounts in 2020. That's according to a 2021 income survey by the U.S. Census Bureau. Congress is now looking to change that with some new retirement planning legislation that's in the Secure Act 2.0 bill tucked away in its end-of-year spending package. Here to break down the impact for your retirement savings is Angela Antonelli, Executive Director of the Georgetown University Center for Retirement Initiatives. Thank you for being here, Angela. This is really important stuff because, indeed, a lot of people, if they have retirement accounts, it's through their workplaces, but there are lots of workplaces that don't offer that. So how far does this bill go towards bridging that gap?
The gap is a huge gap. I mean, more than half of all private sector workers today don't have access to an employer-sponsored plan. State leaders have recognized this and have been adopting state-facilitated retirement savings plans to try and bridge that gap. But what Congress has now done is recognize just how important and how significant this gap is in lack of access to retirement savings, and it's reflected in the provisions of Secure 2.0, which has almost 100 different provisions in it. But some of those related to closing the access gap are really focused on providing plan options that can make it easier for more small businesses to consider adopting plans and therefore covering their workers. It provides greater financial incentives to help cover those costs for small businesses. It also helps to bring more workers into the system by expanding and allowing more part-time workers to be covered more quickly by their retirement plans. And even more significantly, what we've seen and what we've been learning is the power of auto enrollment. And when workers are automatically enrolled in retirement plans, they tend to participate at very high rates. So there's a lot of great stuff in there to help close the access gap and ultimately get workers in there and begin to save and boost savings overall.
Angela, one of the key provisions that I'm looking at that really sparked my interest was the what amounts to matching contributions by the federal government for stock purchases up to $1,000 per person. I got to imagine, I mean, this seems to be a first step, but over time, we know the way federal legislation goes, that amount can increase. That would seem to me to be a huge potential tailwind, not only for stocks, but also for savings for individuals. Just wondering how much focus and anything else you can add surrounding the details on that for us.
Well, I mean, I could speak to it in the context of retirement. I think what we start to see in congressional action around trying to improve and strengthen our retirement system, and by strengthening our retirement system, what they're doing is helping to improve individuals' overall financial well-being. And one of the things that we have to recognize is there's a tremendous amount of inequity in our retirement system today. As I mentioned, the access gap is huge, and that gap is predominantly falls on lower income workers. It falls on often there's inequities by gender and by race that are significant to address. And, you know, one of the things to help boost retirement savings is not only getting people into the system, but for low and moderate income workers, there are things like tax credits, for example, the Savers tax credit that's been available, that's little known, little used. And what the federal government is doing here in the context of Secure 2.0 reform is creating the option of making encouraging contributions, but in encouraging contributions also supporting, boosting the amount that's ultimately saved by making that Savers tax credit better known and also refundable for more low and moderate income workers. So again, this is something that is a significant development in encouraging savings and helping to boost overall amount of savings. But again, by closing that access gap, by doing these, creating these other incentives, hopefully it will go a long way to closing the gap, but also the tremendous inequity we see within our retirement system by gender and by race.
Angela, what's the big hole here? In other words, while this does make progress, what's the one thing it doesn't do that you wish it did to better close the gap and to address inequity?
Well, I think one of the things that we often just forget is the simple notion that employers in the United States don't have to offer a retirement plan. And so, you know, that's part of the reason. And it's particularly difficult. Our system today is particularly burdensome for small businesses in terms of the administrative burden and cost that we put on them to create these types of plans. And so Secure 2.0 continues the incremental steps towards offering more options to these small businesses that are intended to be simpler and lower cost for them, that the industry can be out there, advisors and others working with small businesses to try to cover more workers. And quite honestly, today, given today's job market, I think employers increasingly find it important that they do offer these kinds of benefits to their workers and able to attract and retain workers today. But the reality is we'll have to see over time. Many of these provisions will not take effect before 2024. So we have some time to see what kind of impact they ultimately will have on helping to close the access gap. And will it, in fact, help to have more employers and more workers be in our retirement system and saving for retirement?
Angela, we got time for one more here. I'll give you the floor. Anything we didn't go over here, anything that a retiree should be looking forward to or maybe not forward to in the new year?
So again, a lot of these provisions will take time to go into effect. But again, closing the access gap is going to be significant, getting more people covered in our system today, more small businesses able to offer plans. The ability to boost the level of savings for folks, again, an example of that relates to, debt is often an obstacle to being able to save. Older workers surprisingly have a tremendous amount of student loan debt. And one of the things that one of the provisions of Secure 2.0 allows an employer to be able to make a matching contribution, even though a worker might be paying off student loan debt. But I think even on top of that, in addition to retirement savings, is a really positive focus on overall understanding financial stress on workers today, how that affects productivity, and addressing issues around overall financial well-being. And so things like allowing workers greater flexibility in the case of an emergency to take out withdrawals from their retirement funds if they need to, penalty-free, because the penalties can be significant, to give that flexibility to make those withdrawals, to also now encourage the creation and adoption of emergency savings accounts that sit alongside retirement accounts is also a really positive development that recognizes the challenges that's just part of everyday life and that families face all of the time and may need to address. And then also in the longer term is that flexibility with people who have retirement savings and understanding that it isn't one size fits all, and that individuals need to have some flexibility to decide when they need to and how much they need to take out of their retirement accounts and be able to have greater flexibility to be able to manage that. And that's reflected in things like giving greater flexibility with with the required minimum distributions and what needs to be taken out of the accounts and at what age. So there's a lot of great stuff in there, and hopefully it will continue to move the ball forward in strengthening our retirement system and overall financial well-being for millions of American workers, and also making it easier for employers to offer this as a benefit to their workers.
Well, lots of changes coming down the pike here, as you mentioned, but also coming down somewhat slowly. A lot of these changes not expected to take place until 2024. Thank you for that, Angela Antonelli. All right, coming up next, we're going to break down the top holiday retail trends and some struggles that companies are facing. Up next. Welcome back. Consumers set new shopping records throughout the holidays, but as some purchases failed to live up to expectations, merchandise return and reseller logistics company Optoro estimates $135 billion in goods are going to be returned between Thanksgiving and the end of January. That's even causing some retailers to rethink their return policies. Here to discuss is Optoro president and co-founder Adam Vitarello. Adam, thank you for joining us here today. This is a story that I track with interest every year, and every year it gets bigger and bigger. I got to think that because of the huge changes we saw this year, increases in wages and overall inflation levels, that this would be an especially challenging year. What's your view?
Yeah, good morning, Jared. Thanks so much for having me. Happy holidays. Yeah, so we're seeing returns play an increasingly important role in retail. This year, I think, as you mentioned, returns are up over 12%. And it's not just for the retailers themselves. Shoppers, something like 80% of folks have done an online return this year. And they're thinking of it as a critical part of the journey. And so the big story this year that we're seeing, and we're a returns technology company working with big folks like American Eagle and LL Bean, Tucker Nuck, and others, is, hey, what do you do with this fact that everyone's facing increased costs, right? With inflation, retailers on one hand trying to figure out, hey, do I pass along some of those costs back to shoppers, potentially in the form of charging for return shipping and making returns a little bit more difficult. This is a huge driver of kind of bottom line for retailers. On the other hand, shoppers saying, hey, I'm facing increased costs and I'm actually kind of prone to shop around. And if you don't give me a great returns experience, I might shop with your competitor. And that's what we're facing this year.
Adam, it's Julie here. So it certainly feels like from an anecdotal basis that more companies are putting some of the cost of returns back on the customer. Have you found that to be the case? And if so, how is that affecting the whole dynamic? Are people returning things less if they're having to pay for it? Like, how is all of that playing out?
Yeah, it's interesting. We are seeing that dynamic play out. Some notable brands like Zara, H&M, J.Crew have started to charge for mail-in returns, certain types of returns, and certainly it is having the impact of less returns. I think the other big impact, though, it's having, and this is a kind of the $1 million question if you're in the marketing department or if you're running a big brand like this, is, hey, do we kind of save a quick buck, right, and charge and pass this along to customers? And it does, and it can certainly help reduce returns and kind of put some kind of short-term wins to the bottom line. But also, again, majority of customers say that if you do charge for returns, it's something like 70% say that the retailer should, pass it along to them. And one kind of anecdotal piece is, with all the supply chain issues, inventory levels are quite scarce. And so I think a lot of customers are saying, hey, I tried to go to the store, but I couldn't find anything. And so you made me go online and then I bought something, it didn't fit, and now you're charging me. Hey, that's kind of, kicking me when I'm down. And so a lot of customers, again, are kind of fighting back and saying, hey, you can charge and I will return less with you, but then I may then go along and then shop at your competitor and switch, right? Because a lot of folks are leaning into returns, famously Amazon, and who's made this free for essentially all of its products.
Adam, I got to confess, I don't return a lot of online items simply because of the hassle and because I live in Manhattan and it's kind of a big deal sometimes. Nevertheless, people like you and your company, Optoro, making it easier. Is this bringing up the overall level of returns in the system? Does it somehow exacerbate the problem? Just wondering if you have any stats on that.
Yeah, I think by the way, that is a big trend, is just making online returns easier to return. And I think the other side of that coin, though, Jared, is how do you then make it so that retailers don't incur a ton of cost to process that return? Because, if you buy something in a store, or you try something on in a store and you leave it in the dressing room, they don't call it a return, right? They just say, hey, this thing didn't fit, and they restock it. But if you do that same action online, hey, I just kind of want to see if this thing fits, and then I don't do it, then it's a return and it costs money and all that. And so I think the big trend we're seeing is you got to make it easy for consumers. There's this whole kind of packageless return phenomenon. Folks like Amazon, Happy Returns, Optoro's got a solution as well, where you can just take an online return to any third-party location, in our case, Staples, and just drop it off and make it easy for the customer. What's nice about those solutions, too, is it costs a fraction to actually return it because it ships with other items. It's better for the environment. It's not one by one. And so then it allows customers an easy option to return. It allows retailers kind of a cost-effective one. And so we would say that actually by doing that, you're ultimately just kind of growing the pie for everyone. there are more returns, but there's certainly happier customers and retailers that are selling more. And so I think the kind of most forward-thinking retailers faced with this predicament are actually saying, hey, let's lean into customers, realize that if we give them a great experience, they're going to come and shop again with us. And just because they tried it on and didn't like it, those customers oftentimes are actually their most loyal and ones that come back and shop again.
Yeah, we'll see how this dynamic plays out. We'll probably be talking to you again next year at this time, and there'll be another record in returns, though. Turo co-founder and president Adam Vittorello, good to catch up with you.
Thank you, Julie. Jared, have happy holidays.
You too. Coming up, the bounce back for laid off tech workers. We'll discuss that next. It is time for Gut for Time. 3 stories, 1 minute each, and we start with this. Laid off tech workers are getting scooped up quickly. That's according to a new survey from ZipRecruiter, which showed that 79% of recently laid off tech workers were hired within 3 months of initiating their job search. So this compares, I think, to 83% of workers overall. So it's a little bit lower, but nonetheless, it still shows that even with anecdotally these layoffs happening, the people are still getting hired again.
Yeah, the tech sector, if you're a tech sector worker, good news, you're at the top of the food chain. And so it's not surprising that a lot of these workers would get their jobs back. Now, a lot of the hiring, the insanely aggressive hiring that happened last year, 2021, in the early part of this year, before we knew the extent of the inflation damage, a lot of that was just aggressive for the sake of being aggressive, because companies had to grow no matter what, and they had to grow employee headcount in order to satisfy shareholders. That's what the venture capital community wanted. That's what the street wanted. And so that's what happened. Now, those were some of the first jobs to go, not surprisingly, but anecdotally, tech people are just fine. So if you're crying about tech people not being able to find work because they got laid off this year, probably going to happen real soon.
Yeah, you can dry your tears.
Yes. And a new report from Axios used Google Trend data to break down some of the top news stories of the year, with FIFA World Cup taking the top spot after Argentina's win last week caused a big spike in Google searches. And these stories, I mean, I take a look at all of these stories. We got Ukraine, that was out of left field in the beginning of last year. We got the Powerball jackpot, I barely remember that. Will Smith getting clocked, was that this year? Well,
I know.
Seems like years ago.
That was my reaction as well.
Seems like ancient history. And then the tie, we got Queen Elizabeth and Russia.
So that's kind of a twofer, right, with Ukraine. Elmo was on the list also.
Had to look that up again this morning.
Because Elmo had a viral video where he was upset that Zoe's pet Rocco was getting his oatmeal raisin cookie because, as Elmo said, Rocco doesn't have a mouth. How's he going to eat the cookie? I enjoyed watching that for the first time. So I guess like some of this is a little self-perpetuating. You read the list and then you look up some of the stuff that you missed. But it is interesting to show where traffic was, right?
Yes.
On some of these searches.
I don't think crypto was in there. Nothing about SPF anyway.
Maybe I got to look at that again. Peloton is now selling refurbished bikes for a discount of up to $500 less than new bikes. That's according to a company announcement yesterday. The prices are going to range from $1,145 to $1,995 with the same 12-month warranty that new bikes get. I mean, this move makes a lot of sense, right? Everything from blenders to watches, you can do this kind of thing. You can buy a refurbished item.
Right.
So it makes sense they would do this.
I still find the prices to be pricey, and I don't see that going away. This was a premium product. I remember the discussion 3 years ago we were having at the end of 2020, which is basically where's the top for Peloton because nobody sees it, and now the discussion has flipped. Where's the bottom, at least in terms of the stock?
Yeah, and I don't know that selling refurbished bikes is going to do it, but what has really been the hallmark of Peloton this year, as it got new management, as it really did a big restructuring, was sort of trying new selling channels, right? Having a partnership with Amazon, some of the other places that Dick's Sporting Goods that it's looking at. And so now this sort of represents another selling channel as well, in a way, people who want that secondhand bike. All right, that does it for us. Me and Jared Blickley, thanks for hanging out with me today, Jared. Brad and Saz are going to be back here tomorrow as we see now a mixed picture for stocks once again.
More than 6 million dead, 13 billion vaccine doses distributed, borders closed, lives changed forever.
At the beginning of this year, much of the globe was finally emerging from pandemic restrictions. The world's second biggest economy held on zero COVID was essential, non-negotiable, unflinching, and then the unraveling.
Outrage, protests, public anger not seen since Tiananmen Square. Chaotic scenes in major cities like Guangzhou, protesters demanding an end to restrictions.
Of course, in November, anger at a boiling point, a backlash against a brutal lockdown at the world's biggest iPhone factory.
Then the final straw, a deadly fire in a high-rise building in the nation's northwest region, triggering anger. Protesters blaming the deaths on COVID restrictions.
And now a monumental U-turn. Some say the protesters won, others that President Xi chose to save the economy. However you frame it, China is reopening.
And it will shake global businesses, money markets, supply chains, and 1.4 billion people within China's borders and the world beyond. We look at what it means for all of us. Welcome to Yahoo Finance Live. This is What Just Happened. I'm Akiko Fujita.
And I'm Rochelle Akufa, and we're taking a deep dive into the biggest story of the week and the ripple effects felt across the world.
Almost 3 years since the start of the pandemic, China's COVID policy has officially changed, and the nation's leaders are faced with the reality that they have missed their economic growth target for the first time by some distance. Just 5 years ago, Rochelle, that would have been unthinkable. And we are focusing on the topic over the next hour, largely because of the implications here. Really, the key question is, why is this happening now, and why are we talking about it now? And as we highlighted, it really does, in large part, come down to the economic picture. We're talking about a country that is now looking at a growth rate of about 3%. Some would argue it would be sub 3%. If you want to get granular, its imports tumbled nearly 11% from a year ago. Last month, we saw auto sales down 26.5% in October. These are not good signs. And when you're talking about the world's second largest economy, that's going to have ripple effects globally. And that's kind of what we're trying to focus on over the next hour. We should point out, by the way, we have already seen that pivot from the government. We saw the Politburo meeting on Wednesday, making it very clear, saying that stabilizing weak economic growth is now the priority, Rochelle.
I mean, we really have to wonder, what was the tipping point? A lot of people were wondering, was it the unrest? Because this isn't the first time we've seen unrest in China, but not on this scale, in multiple cities on the same issue at the same time. And as you mentioned, the economic issue as well, in terms of what was the tipping point in accelerating this reopening. We saw that the founder of Foxconn, that's the biggest iPhone assembler in the world, he wrote, according to the Washington Post, telling Chinese leaders that zero COVID would threaten China's central position in the global supply chain. And of course, you remember the chaotic scenes outside of the Apple plant, outside of that Foxconn plant, when employees had to stay in lockdown and were protesting this. And when you think beyond Apple, you've got Samsung, Volkswagen, you have a textiles company that supplies to both Nike and Adidas. And this is coming at a time when the rest of the world is trying to find its feet in terms of global demand and managing inventory. And as China being the world's largest exporter and second largest importer, 8 of the top 20 ports in the world based in China, supply chains need predictability, especially at a time when central banks are trying to grapple with inflation and high prices. And as we have no idea if and when these lockdowns will arise, as these cases are coming up, this is going to be a real wake-up call as we're seeing companies continue to diversify because they just don't know what's going to happen with these case counts, Akiko.
Yeah, Rochelle, while we're going to be focused on the economic picture here, this is all likely to come at a cost. I'm looking at case counts on Friday. The government reported more than 16,800, roughly, new cases. Now, that is officially a decline from the kind of surge we saw last week. But remember, just on Wednesday, we saw the government lift that mandatory testing for all citizens. So there is a question about just how widespread the virus is right now, whether we can get an accurate case count because of these COVID restrictions loosening. And we did hear from Dr. Anthony Fauci over at the White House this week, raise those concerns, saying that if this goes all undetected, there are concerns about new variants that could come out. And he really urged the Chinese government to import Western vaccines, mRNA vaccines that have been proven to be a lot more effective at a time when there are concerns about just how, to what extent the population has immunity, because those vaccine rates haven't been as high. And also they've been vaccinated with domestic vaccines that haven't been as effective. So a lot of questions to raise here, both on the economic side as well as the public health side.
Indeed. Well, let's take a 20,000-foot view of this situation. We have Zongyuan Zoe Liu, Council on Foreign Relations Fellow for International Political Economy. And of course, we have the author of The Sovereign Funds, How the Communist Party of China Finances Its Global Ambitions. Also joining us is Dane Chamorro, Control Risks Partner and Head of Global Risk Analysis and Business Intelligence Practice. Zoe, I want to first start with you in terms of what you saw as the real tipping point here that led to this dialing back of zero COVID.
Yeah, thank you very much, Rochelle, for this great question. I would say there are a couple of factors at play on the COVID and the supply chain shock perspective. To begin with, the protest and COVID-related things, exactly as you just pointed out, the fire in Urumqi, the capital of Xinjiang, really sparked the protest. But it really reflected a deeper frustration and the emotional level of social anxiety, and in particular, Chinese people's uncertainty and to a large extent of the loss of confidence in the economic future. And for example, we've already seen discussions about the possibility of a civil servant, even civil service people getting a potential pay cut. So from that perspective, as you were earlier talking about the economic slowdown from 5.5% target and not being able to meet it, but slow down to around 3% or 3.3%. But that number is actually being painfully felt at the individual level.
Dane, when you think about the protests and how they played out, we have seen them quiet down since the government signaled that they are going to back off the zero COVID policy. I wonder if you think there is a risk on the government side in responding to that. They haven't necessarily said, yes, we hear you, we're going to change it because of you, but it did have an effect. And the zero COVID policy in many ways has been really the key to Xi Jinping, the communist government, being able to have such a tight grip over the last 3 years?
Well, I think China was going to exit this policy at some point. The question was when and how. And the Chinese model for pretty much all things is a very measured approach. So I don't think anybody should take away from this that it's going to be an overnight black and white difference between what came, a few weeks ago versus what will come now. It will be a measured, stepped approach across the country. And of course, again, China's a huge country, so you have huge disparities between different parts of China. And what you'll see is them, taking a couple of steps forward if they need to, but perhaps taking a step back. But fundamentally, I think what you're going to see is that by the second half of next year, after the Lunar New Year, which comes in January, and after the National People's Congress meets that happens every year in March, April, the Lianghui, as they call it in Chinese, you're going to see the economy come roaring back because there's a huge amount of pent-up demand, just as we saw in other parts of the world as those economies opened up after certain types of restrictions. Demand came roaring back. And the trick will be, for businesses particularly, will be, can you keep up with the demand? We saw that outside of China as different economies opened up. But as you alluded to, the Chinese economy is so huge, this demand will come back, and the capacity, the trick will really be maintaining capacity domestically to service that demand that comes roaring back in the second half of next year.
And so a lot of people wondering, is there a way to quantify just how much economic damage has been done by zero COVID? And as we said, this is a slow unfolding. And you're saying even with COVID being a priority, there are 4 other Ds that are tied to the Chinese economy that are also on the table. You have demand, debt decoupling, and demography as well.
Yeah, thank you very much, Rochelle, for referencing an article that I wrote last month. Absolutely, a lot, exactly as Dan pointed out, as China slowly reopens, we'll probably see a temporary or short-term rebound, just exactly as what happened here in the United States or elsewhere in the world. However, it does not necessarily solve the long-term structural problems. And on top of that, if we just think about the cost of zero COVID or the the unmaterialized GDP cost, right? So if we do a quick, back of the envelope calculation, the Chinese economy is somewhere between $17.7 trillion. And if we say like 2.2 cost, because the economic target was 5.5%, and now let's say optimistically it's 3%. So we are talking about somewhere between 2% or 2.2% loss in GDP, and that is somewhere between $380 billion. So that's not a insignificant amount of money. And on top of that, we're also talking about a lot of major global companies thinking about pulling out of China, or even have accelerated their pulling out of China. So from the long-term perspective, both international factors and domestic factors probably is going to make the Chinese economy in the long run not necessarily going to materialize the so-called 8% growth potential as some Chinese economists might have optimistically estimated.
Zhong Yuan, Zoe Liu, appreciate you joining us along with Dane Chamorro from Control Risk. Thanks so much for that. We'll travel to Shanghai today, and you'll have over 1,000 Starbucks stores to choose from. And you can even find a Dunkin' or Blue Bottle if that's your thing. China is big business for U.S. corporations of all stripes, but many of these slashed investments this year. Are we on the road to recovery? Yahoo Finance's Inez Ferre has the details.
And Akiko, it's important to note that when we're talking about U.S. companies and China, there are two aspects to this. The first is the Chinese consumer and the sales and services that these U.S. companies provide to the China market. And we have seen U.S. companies talking about their declining sales because of the COVID lockdowns in China. For example, you had Starbucks that talked about its revenue miss because of same-store sales down in China. You also have Estee Lauder, which has lowered its profit guidance. And then you've got companies like Nike also talking about its revenue down in China. Now, on the other side of this, you have the manufacturing side of this, because many U.S. companies made big bets on China as being their main manufacturing hub. And so we saw during the pandemic, the supply chain issues, you had companies that were kind of rethinking their strategy. And now with the COVID lockdowns, those recent lockdowns have also accelerated those plans. And I will leave you with this, and this is the American Chamber of Commerce in Shanghai latest survey of U.S. companies. 19% of respondents said that they were going to plan cutting their investments in China in 2022. That's up from 10% last year. And mainly one of the top reasons, or the top reason, was the zero COVID lockdown that had been happening in China. Akiko? In fact, Praz, let's go to you now.
Hey, Inez, thanks for that little report there. Up next, it's been over a decade since China became the world's biggest auto market. We'll take a look at the impact the lockdowns had on one major U.S. corporation amid fresh reports of production cuts. More on that after the break. Welcome back to Yahoo Finance Live. This is What Just Happened. I'm Pras Subramanian. Let's talk about China's auto sector. From Detroit's Big Three to Volkswagen, building market share in the nation has been a critical goal for decades. COVID put a wrench in that plan, to say the least. VW Group, one of the many taking a hit from COVID-related stoppages, though a major plant in Chengdu just reopened a few days ago. Tesla, meanwhile, suffering from an ongoing demand issues, leading it to cut prices and reportedly slashing output at Shanghai Gigafactory. For more on that, let's bring in Dan Ives, senior analyst at Wedbush, who joins me now in studio. Dan, thanks for joining us. Let's talk about overall big picture in China. What's your take on what's happening there with all the COVID-related stuff with regards to automakers?
Look, it's been a nightmare. I mean, I think you're starting to see cracks in the armor for the first time in many years. And obviously competition is increasing in the EV landscape. You've seen that. I almost call it a Game of Thrones going on between Tesla and NIO, XPeng, and others. And I think that's the hearts and lungs of the overall EV bull story. So I think you've seen a lot of pressure on these automakers, and it's a storm they need to navigate.
You know, you mentioned Tesla. You know, we've seen reports of production cuts. They've had to cut prices as well, and actually adding some sort of insurance incentives. Are you kind of worried about Q4 for Tesla?
Look, I think after the Cinderella ride for the last 3 to 4 years, I mean, they're hitting some hurdles. And I think you've seen that. And even though a lot of it was, we'll call it production or supply chain driven, you're starting to see some demand cracks. Now, look, I don't believe the longer term story in China is thrown out the window. I just think they're navigating now some really, for the first time in years, some growth challenges. They're cutting price. You've seen some, I'd say, supply chain reductions. And now we got to see, not just in Q4, but 2023, 2 million units. That's the line in the sand globally.
So you think that with these sort of production, the COVID restrictions going away, that Tesla might actually have some kind of runway here?
Look, I feel like that's it's similar as Apple, right? I think that's going to give them a little more flexibility because right now you got consumers locked in their apartments or houses. They're not focused on iPhones and Teslas, right? Or Lululemon pants. And I think that's part of the problem is that now what's a normalized environment look like in China? Recession's clearly hit, but now I think the street's starting to look past this and what does 2023 look like? I think that's really the focus right now, not just for Tesla, for NIO, XPeng, BYD, and others.
So GM also, a lot of operations in China, a bunch of joint ventures there. They've also come out with their newest EV game plan, the updated game plan, where they're seeing profits kind of push forward a bit from those types of vehicles. Is GM kind of better positioned in China than Tesla?
Look, I mean, and I was there in Detroit this week, spending time at the headquarters. I think right now the most underestimated story across automotive is GM. I think the transformation that Mary and the team are building on EV is a lot of skepticism. I believe we're going to sit here 2-3 years from now and view this as a really pivotal sort of chapter for the company because it's Ultium, because they ultimately own that food chain. You start to do some math, I believe this could be a stock that gets significantly re-rated. And even if China for them is insignificant, in terms of with the conversion opportunity for GM, there's a renaissance in the 313 area code between GM as well as Ford.
And that Dearborn rivalry, that crosstown rivalry. Back to China again, we're talking about the world's biggest car market, the biggest EV market by far and away. We talked about GM and Tesla sort of battling it out. Maybe one of those guys will be on top. But could it be BYD? I mean, they're really knocking out of the park with EV and hybrid sales. Are they sort of the sleeping giant there?
I think they are. I think that's one, everyone knows them, but I think under the covers, that's sort of probably one of the biggest opportunities for them in terms of in the China market. Now, look, the golden child continues to be NIO, in terms of what they're obviously doing. But look, it's not a zero-sum game, and I think that's the one that's important. You're going to see a lot of vendors continue to benefit. You still have conversion in terms of overall EVs that's in the low teens. A lot of opportunity ahead.
There's a lot of opportunity there for multiple competitors there too. Dan Ives, Wedbush, thank you so much for joining us.
Thanks for being here.
Rochelle, over to you.
All right, great stuff, Pras. Well, another company dealing with its share of complications from China's COVID measures is, of course, Apple. Now, the issues stem not just from a manufacturing perspective, but demand. China makes up nearly a quarter of the group's global sales. Yahoo Finance's Ali Garfinkel has that story for us. Hey, Ali.
Hi, Rochelle. So it was in late November that violent protests first erupted at that key Foxconn factory in China. This was major for two big reasons. The first is that this factory was and is producing iPhones on a massive scale. And like we've talked about, it was a rare scene of public violent dissent in China. The protests, of course, came after weeks of strict COVID lockdown procedures and years of China's zero COVID policy. it all really came to a head, honestly, with Apple, and now China's manufacturing relationship with the company is now inextricably connected to the government's decision to pull back on its COVID policies. We saw that Foxconn letter come in from, Terry Guo saying this is going to affect the global supply chain. However, the damage maybe has already been done, right? There are some numbers out there that are pretty jarring. Apple is down about 6 million iPhones as a result of these protests. And, we're starting to see that the company has reaffirmed its plans to diversify its manufacturing away from China to India. This was something that has been talked about for some time, but there's definitely a sense that it's been sped up here. By 2025, Apple could make 25% of all its iPhones in China. I don't know if it would have accelerated the way it has, certainly, Rochelle, if we hadn't seen these protests. The bottom line here from my end is that this period in that China is now coming out of maybe has had permanent or at least lasting effect on the company's manufacturing relationship with Apple. Bottom line, China's strict COVID policy, I think it caused the human link in Apple's supply chain maybe not to break, but certainly to bend. Tossing to you, Jared, in the studio.
All right, coming up on the show, global supply chains don't function when the world's growth engine stalls, but with U.S. ports already feeling the pressure, what happens when container volume from Shanghai ramps up? We're going to tell you all about it up next. Welcome back. This is What Just Happened. I'm Jared Blickery. Turning now to the impact on the supply chain. Prior to the pandemic, Chinese GDP that stood at 5.5% and was viewed as a floor. Then the unthinkable, negative growth in 2020, which we see right here. It was reversed like a slingshot, after settling down a bit. The latest economic print came in at 3.9%, and economic prosperity was essentially sacrificed for political control. So probably not a coincidence that the dramatic policy change was enacted just as Chinese trade data was falling off a cliff, with both November imports and exports slowing by the greatest amount in years. Now, drilling down into some familiar U.S. company names reveals the extent to which the Chinese and U.S. economies have become intertwined. Now, take Apple. Many companies derive the majority, in some cases substantially all of their revenue from this one behemoth. Takes Foxconn over there on the left. That gets about 57% of its sales from Apple. Also note that the giant chip company Taiwan Semiconductor gets over 1/4 of its sales from Apple. Now that is a huge slice of a huge pie. And it's a very similar story for Nike. Fengte Enterprises derives 87% of its sales from the shoe and apparel giant, while Shenzhou International 25%, Yuyuan Industrial 22%. So in the grand scheme of things, China lockdowns were affecting some U.S. companies across the entire demand-supply curve. Now, one bright spot, at least when it comes to shipping, is container rates, which had already surged fivefold in 2021. They had already come back down to earth. The cost to ship from Shanghai to Los Angeles, New York, or Rotterdam, now about 80% off of those highs, which we see here. And you can see this goes back about 10 years. Finally, we are in a range that we have seen that's manageable over the last 10 years. Now, some say that the stock market is forward-looking, and Chinese stocks started rallying about 4 to 6 weeks ago, and these are the results over the trailing month. And you can see a lot of these stocks on the top line, some of them up more than 100%. Bilibili up 155%, Dada up 125%. So a lot of work to be done, but some of that already reflected in the share prices. Over to you, Akiko.
Yeah, Jared, you have to wonder how much of that rally that we're seeing has to do with how far these stocks have fallen. But thanks so much for that, Jared. Well, chip makers were certainly one group affected by the ongoing supply chain backlog, but that wasn't the only issue for the sector. TSMC has long been a barometer for the health of the sector. U.S. investors expressed uneasiness about Taiwan Semiconductors earlier this year because of national security concerns around chips and Taiwan. Some of those potentially resolved by the company's investment in a U.S. plant in Arizona. Now, though that investment is now drawing concerns in Taiwan, where chip manufacturing is the backbone of the economy. Let's bring in Needham co-semiconductor analyst Charles. Charles, I want to see if we can kind of separate these two issues. There's the issue of national security, and then the issue of the backlog that happened because those borders were shut down during the pandemic. How much of one is driving the other?
Well, I want to make sure I understand the second part of the question. But first, let me address the first part on national security. I think from a business perspective, it's national security issue actually for the companies means the business continuity issue. I think one thing that over the last 3, 4, 5 years, as Taiwan Semi rises to where they are, the global giant, that's what the President Biden said, they become a near monopoly at the most advanced semiconductor manufacturing. What that means is companies like Apple, which account for Taiwan Semi's 1/4 of the sales, they don't quite have alternative to Taiwan Semi. So to those companies, what that business continuity means is they would like Taiwan Semi to have a little bit geographically diversified manufacturing footprint. Taiwan Semi hadn't been really have much presence outside of Taiwan, and their initial plan in Arizona has been seen as probably that's a token fab. That's what I heard. But I think 2, 3 days ago, the big announcement in Arizona that definitely shows that their commitment to provide their customers the business continuity by solving the business continuity issue for the companies, for the customers. I think indirectly that addresses the national security concern by the United States and quite frankly, many companies, many countries in the world that depends on Taiwan Semi to provide the most leading edge semiconductor manufacturing.
Yeah, we have seen this administration firmly focused on onshoring production. And my question to you is, how much of that stems from what happened during COVID, the realization of the over-reliance on Chinese production? But separately from that, how does China now respond to this policy at a time when they may not have the most advanced equipment coming in from some of the Western countries?
Well, I think semiconductor industry is a globalized industry. Let's not forget that. It was born in 1960s, 70s. It grew as the globalization of the develops and actually lifted China out of poverty, right? Starting from the 1980s. I think even for China, the access to global semiconductor technology is important. I don't think it necessarily should mean that China should have everything on its soil. just like U.S., the U.S. doesn't have everything on the U.S. soil. I think it's unfortunate that there are signs of deglobalization in the recent years. But I think a semiconductor industry, this is an industry where if you have the technology, you have the customers, you have the demand. If you don't have the technology, you just don't have that. Well, you just can't do anything about that. So in terms of how China going to respond, I can't really provide a clear answer, but I think from China's perspective, they would rather keep the access to Taiwan Semi. I mean, at least the Taiwan Semi, at least that's what they would prefer to do. But I think for business continuity standpoint, they still should have, they should think about providing the alternative geographical manufacturing footprint to their customers, not just in Taiwan, maybe in the US.
And Charles, you added TSMC to the Needham conviction list, but you do expect the wafer shipments to start declining in the first quarter of 2023. Walk us through your theory there.
Well, semiconductor industry is actually it's cyclical, but it's actually surprisingly consistent in terms of the trend line. The trend line is there, the 20, 30-year trend line. It's a growing secular growth industry, but when the shipment measured by unit goes above the trend for a period of time, which is something we have seen starting in 2020, 2021, lasted into at least the first half, maybe the third quarter 2022, you will go under the trend for a while to bring the overall trend to the long-term trend line. So what we think is going to happen is there will likely be a reset of Taiwan Semi's unit shipment or the wafer shipment starting in Q1 2023. But the reset is actually good news for the stock. So we'll likely see next year is the numbers may come down. They may miss estimates, but the stocks may actually do very well next year. That's my projection here.
All right, we'll certainly be keeping an eye on that. A big thank you to Needham & Company semiconductor analyst Charles Shi. Thank you so much. All right, now let's get to our very own Rick Newman, who will tell us what's coming up next on this week's What Just Happened. Hey, Rick.
Hey, thanks, Rochelle. Coming up next, we've seen the first annual decline in China's energy demand in 20 years. But if China's energy economy comes roaring back next year, does that impact your price at the pump? I'll give you the crude reality next. back to What Just Happened. I'm Rick Newman, and we're taking a deep dive into the China effect. Let's talk about oil and energy demand and why America might be the winner here. Now, China's COVID shutdowns have meant reduced demand for energy, which has lowered prices, including the prices we pay here in the United States. And if China rebounds next year, that could mean higher prices here. Let's start with where we are right now in energy markets. We've got gasoline prices here in the United States at about $3.30 a gallon, obviously way down from $5 a gallon that we saw in June, and oil prices here in the United States around $72 a gallon. That's down from a high of around $120 per gallon per barrel over the summer. And that's good news for Americans, obviously. President Biden and the Biden White House, they keep sending out press releases, making sure everybody knows that gas prices are now actually lower than they were a year ago. Biden is taking credit for this. He has released oil from the strategic reserve, and they just put in place this complicated price cap on Russian oil. But that is not the main reason energy prices are down here in the United States. The biggest reason energy prices are down is reduced demand from China. This is a sleeper factor in the energy industry. Not too many people are noticing this, but if you don't take my word for it, let me tell you what S&P Global Commodities said in a briefing I participated in earlier this week. They said China's COVID policy, meaning the lockdowns, is the most important fundamental factor for energy markets. Were it not for this demand weakness, prices of all commodities would have undoubtedly been higher in 2022. And if China's energy demand and imports are strong in 2023, commodity prices will be well supported. Now, well-supported commodity prices means higher commodity prices, and we're talking about not just oil and gasoline, but also natural gas. And those are things that we are affected by. So S&P actually does forecast a significant increase in demand from China for those forms of energy this year. And that probably is going to mean higher gas prices here in the United States. Now, how high are we talking about? If you go back, if you look at an oil price chart and you go back to 2011, look at the 2011 to 2014 timeframe, global oil prices hit $100, $110, and a lot of that was because the Chinese economy was booming and they were just buying tons of energy. When the Chinese economy really gets going, it totally supercharges prices for commodities. So we may be at a bottom here for energy prices. If people could stockpile gasoline, I'd say go do it. You can't really do that. But if China does come back, as many economists think, that is going to mean higher gasoline prices here, higher electricity prices, and higher heating prices. So in a way, it would be good for Americans if the Chinese lockdowns continued. Back to you, Rochelle.
Indeed. All right. Well, a big thank you to Yahoo Finance's Rick Newman. They will be keeping an eye on those gas prices. We're also keeping an eye on crude oil, just one part of the commodity market that will be impacted by China's reopening. Let's not forget, expansionary economic policies in Beijing have been the main driver of everything from silver to copper and iron ore for over 2 decades now. The latter hitting its highest level in 4 months today on expectations of a revival of the crucial property sector. Well, for a broad look at the commodity space now, we're joined by Path Trading Partners co-founder and chief market strategist, Bob Iacchino. Thank you for joining us today, Bob. So first, I want to start with the oil picture. We're seeing that oil is down for the week. A lot of that perhaps tied to the reopening, some of it jitters, wondering with the Fed as well. But what are you watching in terms of the oil picture and what we can expect in terms of demand with China?
Well, good morning, and thanks for having me again. Oil, to me, has a characteristic to it. It almost has a personality in terms of price action. And that personality is basically it trades in a wide sideways band of price until there's some sort of disruption to either supply or demand. Recently, we've had disruption to demand expectations based on slowing economies. The China story has been priced in multiple times in crude oil, and it hasn't really stuck. Now, that doesn't mean it's going to change things now that there is a version of reopening, but there's a devil in the details to the reopening. China hasn't been buying as much crude as they had, but they were still buying quite a bit of it from Russia. There's evidence right now from some of the people we speak to that they're buying despite the price cap, and Russia is self-insuring to get around those rules. So they have a source of energy that isn't necessarily going to be crude oil that is taken off the global market because it's Russian crude oil, which theoretically is already off the global market. So while I agree that if they come back like they did in 2011, we're going to see higher energy prices, there's a caveat to that. When you reopen and you don't have widespread vaccinations or very good healthcare that is COVID-based, you could lock down sectors again. You could see people voluntarily not traveling at the rate that they maybe would have. That's probably down the road. We saw in the protests that the Chinese populace really wants to get out of these lockdowns. But once those numbers start crawling up and the death rates start crawling up again, they may change their minds and you could see a little bit of a slowdown. That's crude oil specific.
So, Bob, I mean, if we bring it back to those comments that Rick got from S&P Global saying that China's COVID policy is the most important fundamental factor, I mean, it sounds like you're saying that's not exactly the case because the virus case counts could really sort of dampen this push for additional demand coming out of one of the largest markets.
Well, Akiko, I'm not saying it's not the case. I'm just saying there's two sides to that story. It isn't a guarantee that simply because China is reopening, they're going to go gangbusters buying energy like they were in 2011. And to be fair, I don't think that's what Rick was saying either. I just think he was bringing up the upside case since we've been so far to the downside. And I do think we've put in a short to medium term bottom in crude oil here. A while back, I was on, I believe it was your show, where I said 65 before 105. I still believe that. That's a little easier to say now that we're in the low 70s. But then I really don't see us getting to 100 at least till the U.S. summer driving season arrives again, simply because, number one, you have to worry about the health of the global economy. And whether you believe there's going to be a recession or not, there's a slowdown in place. You see it everywhere except for the non-farm payrolls data. Everywhere else, there's a slowdown, at least in the U.S. economy. And also, we're likely to see the ECB and the Bank of England be aggressive next week in the face of double-digit inflation. So you're likely to see slowdowns continue there. But from that perspective, China can make up for their own consumption and get prices up maybe $15 to $20 from where they are now.
And how reliant should they be on sort of what they're seeing in terms of domestic demand, especially when you think of things like metals as well?
Well, copper, obviously a key one. China's been for quite a long time the biggest consumer and smelter of copper. We've seen copper go up in the last 12 sessions, almost 9%. Since the end of September, since those lows, when the talk of the COVID zero policy being pulled back by China started, copper's up 18.25%. So there's been quite a move, but we're still only back to February 2021 levels. And I think this reflects, Rochelle, the balance between global slowdown and China reopening. China will absolutely spend, they will build. So that's why I think crude oil and industrial metals are almost two separate stories on the backs of the China reopening. If China is reopening aggressively and putting that stimulus into play without sort of policy lockdowns, people can decide on their own, sick or not, to use less fuel, especially as we get into warmer temperatures in the spring, but the government can still build and they're likely still to drive copper higher. Plus, longer term, I believe copper is a play long anyway. And why I say that is because I don't think electrification is slowing down, and the amount of copper and other industrial metals involved in the electrification of the globe, the decarbonization of the globe, those numbers are large.
Bob Iaccino, always good to get your insight. Path Trading Partners co-founder and chief market strategist. Now let's go to Anjali Kamlani, who's going to tell us what's next on This Week. What just happened? Anjali.
That's right, Akiko. Coming up, the economic impact of China's policy change is huge. But what about the risk from COVID itself? Quarantines, mass testing, and lockdowns won't do the job they once did. Could the impact really be 2 million deaths? We'll discuss next. Welcome back to Yahoo Finance Live. This is What Just Happened, and I'm Anjali Kamlani. So far, we've heard the various ways China's COVID struggles have trickled down into the economy and business. But it's time to focus on the one thing itself that started it all, COVID. China took its first major steps this week to loosening a strict zero COVID policy, and for the first time, the nation all but ending the threat of mass lockdowns. Here's a recap of what happened and what China is facing in the months ahead. The timeline. The apartment fire on November 24th. That's what resulted in 10 deaths and was the final straw in a series of events that began in October. First, Foxconn locks down and keeps a closed loop on its workers. But that strategy backfires as migrant workers start to flee. The city of Zhengzhou then locks down, followed by Shanghai. Around this time, China is starting to take small steps to ease restrictions, such as reducing quarantining for inbound travelers, as well as reducing the number of close contacts. But then protests erupts at the Foxconn plant, Apple's biggest iPhone manufacturer. Once again, the Chinese find themselves struggling to access basic necessities and facing limitations on where they can go and constantly taking PCR tests. But then that deadly fire on November 14th really sparks the nation's northwest area, and protests erupt across the country. That's when President Xi then has to take some steps to ease the policy. It's the first time the Chinese can start to move freely, except for areas of high circulation, and will now be limited to just buildings and floors rather than entire cities or neighborhoods. But the big problem with all this is it's the winter season. We know that COVID and other respiratory viruses thrive, and some projections estimate millions of cases and China potentially reaching 2 million deaths. Because of its lockdown policies, China has successfully curbed these kinds of outbreaks and these numbers that we saw around the globe. But it means that the population is more vulnerable. There's less vaccination rates, especially in the elderly. They're more susceptible to severe COVID and death as a result of not having exposure to the virus. And the efficacy of the country's homegrown vaccines are also in question, even as the country is working to put its own mRNA contender on the market and has been reportedly weighing imports only for the non-Chinese population of Pfizer's vaccine. And so putting it all together, it paints a very concerning picture as the virus will continue to strain the economy. Over to you, Okiko.
Yeah, Anjali, really quickly here, because I know you followed this very closely. On the vaccines themselves, I mean, what are the prospects for an mRNA vaccine that's developed domestically? I mean, we have heard the criticism before that the domestic vaccines simply aren't effective enough.
They aren't effective enough. I would actually compare it to maybe even the AstraZeneca vaccine, right? It's a similar process where some populations may benefit more than others based on the efficacy, based on the technology. The mRNA contender, they're looking to get on the market by, I believe, March was the earliest I saw. So in the early part of 2023, whether or not it can stand up and hold up to Pfizer and Moderna and sort of the baseline that they've set is really what will remain to be seen. They already have a nasal vaccine on the market, which is something we don't have here, and the U.S. market is trying to catch up with the rest of the world. So it really is a mixed bag in terms of the picture of that efficacy, and we don't have any results yet to figure out.
Yeah, it's certainly going to be critical over the next few months, and I know you're going to be watching that. Anjali Kamlani, thanks so much for that. Well, coming up, the long game. In the years just preceding COVID, China contributed 30% to global GDP growth while positioning itself as the next great economy. Is the grand strategy still on course? We'll look ahead next.
We've spent the last hour analyzing the complexity surrounding China's reopening. So Akiko, obviously our guest went through a lot of topics covered. What are your main takeaways?
I mean, there's certainly a lot of takeaways when you look at the threads that we have to follow following the extraordinary events that have played out over the last few weeks. Of course, we started with the fires over in Urumqi triggering the protests that happened. And then we're talking about the economic picture as we continue to see China reopen. But one factor we haven't addressed as much is what these protests mean, especially for younger workers as well as migrant workers. When you think about how this all started, yes, it was about the fires that happened in Urumqi and concerns that those residents were locked in because of COVID. And that was the reason why they couldn't escape. But at the same time, this points to brewing dissatisfaction that has been happening in China. When you look at youth unemployment, more than 20% right now, and then you look at migrant workers who have had to stay back when their factories have been shut down. They haven't necessarily been paid during that time as well. Now you've got the Chinese government not necessarily apologizing, but at least acknowledging what happened and then responding to that. You have to wonder if that's going to add to more protests to come. Should point out, Rochelle, just one point here. When you think about how widespread all of this was, we're talking about more than 40 protests across more than 20 Chinese cities, and that simply is something we haven't seen in decades.
It's true. I mean, and when you figure that we're about 3 years into this pandemic and we've seen the rest of the world opening up, and then you look at China still having these zero COVID policies, you could sense this growing frustration. People can't plan for their lives. How do you work? How do you plan to buy a home if you're not sure when you're going to be in lockdown? And touching on something else that one of our guests was talking about, that COVID perhaps exacerbated some things, but there are underlying economic issues that, as you said, maybe that could also produce unrest. We saw from Zhongyuan Zoe Liu, she talked about 4 Ds that could be holding back China's economy. Those are demand, debt, decoupling, and demography. I mean, when you talk about demand, we're seeing global demand starting to slow down. When you talk about demography, you have an aging population in China. Debt. China took on a lot of debt over the course of COVID, trying to prop up the economy. And of course, this decoupling, this sort of shifting of some of these international relations, as we see this pivot perhaps away from the US in terms of competition, turning to others in the region like India, turning to Saudi Arabia. So a lot certainly at play here, but a lot of moving parts, and we'll have to see just how this reopening actually ends up trickling and how fast it ends up rolling out.
No question about that. That does it for this week's That's What Just Happened, I should say. I'm Akiko Fujita, along with Rochelle Akupo. Thanks so much for watching.